Okay, hi everybody. Welcome to the Trade Guide and Mentorship Program, the key principles used in volume spread analysis. My name is Gavin Holmes. I'm the author of the book Trading in the Shadow of the Smart Money, and I'm also an expert in something called volume spread analysis, which was taught to me by Tom Williams. And Tom, very hopefully, will be joining us next week for part two, and he'll be sharing with you some of his knowledge. Tom is now 85. He was 85 only a few days ago on the 4th of January. He's in fine form, and he's always been enjoying his trading, and he really enjoys teaching, which is what I do as well now, and share the knowledge that he shared with me some 14 years ago. Now, a lot of you in this training course are quite new to VSA. I know that because I went and looked at all the sign-ups. We did fill this course completely, and so basically I know that a lot of you are completely unfamiliar with volume spread analysis because you've only joined us in the last couple of weeks. But I also know there's some of you in this room that have been with us for 2 or 3 years, and you're still just reinforcing the principles. I believe the best way to learn anything in life is repetition, and repeating stuff is how I learn. I sat with Tom, and I'd ask him the same question week in, week out, and he'd give me the same answer, and eventually it sunk in, and I suddenly became a very competent trader. I currently trade with a fund here in England. I trade several large accounts, and I also trade a public account, a small account. And we are developing a number of things at Trade Guider over the coming years to assist the retail trader to understand that the markets are moved deliberately by big professional players. The markets are manipulated. I'll make that statement. They're not as fair as you think they are. But the good news about market manipulation is that when you can read volume, you put the edge in your favor massively, as I'm about to teach you. There are certain things that happen in the markets that seem to be unexplainable. For instance, in 2011, the public were told to go and invest in gold because it was a safe haven. In 2013, gold had its biggest fall in 30 years, and many investors lost a lot of money. I'm pleased to say many of the Trade Guider users and community, like myself, were short gold during 2013, and we did very well. In fact, it was my best trade last year, was I was short gold. I was actually short from 1600, and it actually hit 1200 at the end of the year, which was my point and figure projected forecast. Now, I trade in different time frames, as you're going to learn. One of the things I do is I don't pigeonhole myself as a scalper or a swing trader. I just like to trade where there's money to be made. And in certain markets, you can be in and out of a market within 5 minutes, and you can make several $100,000 if you're trading a big account. In fact, the trade I took on Thursday in natural gas was a trade that I sent an alert out on, and in the space of 4 hours, I made just under $1,400 with a risk of $110 because I let the trade run. And I'm going to teach you how to identify those setups. In fact, I'll actually show you the natural gas setup that I actually traded because it's one of the best setups that I make most of my money on in this particular setup. So we're going to start with that. Now, let's just talk a little bit about who I am and Tom is. Tom Williams, I think you all know. He's also an author like myself. And Tom, as I say, is now 85. I've been trading myself for just over 14 years. And I've been actively trading publicly at trading competitions around the world for the last 3.5 years. And I've been very fortunate to meet a lot of people all over the world. I spent a lot of time in Poland. Some of you here will know that. I've got a bit of contact out there called Rafał Glaniszki, who's an excellent trader. And we work together. I've spent a lot of time in Asia and Australia. I've been to Saudi Arabia and Jordan. So I've travelled quite extensively to teach VSA. I've just been told, actually, by my book publisher that the book's nearly hit 1 million copies in distribution, which is quite staggering, to be honest with you. I never thought we'd ever achieve that. Now, what we're going to talk about in the mentorship course is, as I said, we've got 2 main sessions each day. I say approximately an hour and 15 minutes. Sometimes I do overrun, but I know you've all got different schedules, and I'll try and keep it within the schedule. I do encourage audience participation. Don't be shy to ask a question. Even if you think it's stupid, I don't mind. We all learn in different ways. Some people are visual. Some people like reading books. Can I just ask you all, please, and please all of you type in either yes or no to this question. Have you read my book, Trading in the Shadow of the Smart Money? Yes or no? Just a Y or an N. It's quite important that I know this. Please all type in. Okay, for those of you that said no, I will send you a copy of the book as part of this course. You just need to email me, and it's a PDF, and it will complement very well what we're doing in this course. In fact, some people don't like to read. I'm not a particularly big reader of books, although I have been over the last few years. But if you haven't got a copy of my book, please email me. I will send it to you with my compliments as a PDF download. And it really will reinforce everything I'm going to teach you over the next 2 Saturdays. So please don't hesitate to email me, and I will send you a copy of that book, which when you print it, it's in colour. It's very worthwhile looking at some of those charts in there, because everything I'm going to teach you today and you've got questions on is covered in the book as well. So it's a good way to learn. As I've said, no question is a silly question. So if you don't understand something, ask me. We cannot all talk at once. So again, I have the ability, if you feel happier, to open your microphone, if you have a microphone or a headset, and you can ask me the question, but you just need to type in microphone so I know to open your microphone. And then if you have a headset, you're able to ask me the question. So if it's a question that's too long for you to type, just type in MIC, mic, and I will open your microphone and you can talk to the group. Okay. I do recommend that you have a pen and paper to hand to take notes. I do recommend you do that, because although you're going to get a copy of the recording, and we are recording this, and it will be with you for the rest of your life. You can listen to it in the car. You can, in fact, one guy who was on my mentorship course with me last year, he said, Gavin, I'm now working for a hedge fund. I'm the top trader there, and VSA really turned me around. And I said, well, how did you learn it? I'm interested. He said, well, I read your book. He said, but then I realized that, I spend a lot of time traveling and I'm on the road a lot. So I took the mentorship course, and all I did was put it on my iPad, and when I'm in my car, I was just listening to the repetition of what you were saying, and then when I could stop and actually look at the pad, I could look at the actual charts, and he would visualize the trade setups, and he became very successful. That's how he did it. Now, before I start getting into the VSA, I want to talk about what makes a really good trader and investor in these markets. There's a number of things, and I've traveled the world. I've met thousands and thousands and thousands of traders and investors. I've met some of the best traders in the world trading millions of dollars, and I've met some traders who just cannot make money in the market. They just seem to continually self-sabotage themselves and not do it. Now, what is the difference between the trader making millions and the trader losing their accounts? The difference is this is what I'm about to show you. The trader that's confident and makes money consistently, they all seem to have the following qualities. And, it's no particular order, but these are the things I've learned. Now, the first one at the top is what I found for me to be the most difficult part of trading: patience. I'm not a very patient person by nature. I like to get results quickly. I don't like to sit at a computer for 4 hours and not do anything. It seems to be a waste of time. However, I learned from Tom very early on that if I was jumping on trades that weren't really there, I was going to blow my account up. And that's exactly what happened the first time I began to trade. Tom said, you're going to have to lose an account, really, Gavin, to learn properly how to trade. Trading is a rite of passage. It's not, you don't just start trading and suddenly make millions. You have to learn it. It's a bit like playing golf. For those of you that have ever learned to play golf, you have to have lessons. You have to go out and practice. You don't hit a scratch round the first time you go and play a round of golf. I know, because I'm useless at golf, and I've had lessons, and I've tried and tried and tried, and I gradually got better by just going on the course once every or twice a week and practicing. And it's exactly the same with trading and investing. You've got to keep doing it to get good at it. I trade every single day. There's very few days I don't trade when the market's open, I mean. And I only really trade now for about an hour and a half a day. I make all my money in between 1 and 2 hours, specific times. And I can tell you those times. It's between the London Open and the US Open. And it's, for me, 1 o'clock in the afternoon, lunchtime, through till about 3:30 p.m., 4 p.m. That's when the market moves. And I also trade after news events as well. So what makes good traders? Well, patience, timing. And what I mean by timing is knowing when everything's lining up for a good trade. I use multiple time frame analysis. We'll talk about that next week in more detail. And multiple time frames means I'm not just looking at a 5-minute chart on its own and that's it. I'm looking for trend alignment in time frames that I use, and I'll share them with you. The time frames I use for the futures contracts, I use a 4-hour chart, a 1-hour chart, 15-minute chart, and a 5-minute chart. Those 4 time frames work extremely well for intraday trading, meaning you're in and out the market, you're not holding positions overnight. And, someone said to me, I got an email from a guy who said, Gavin, look, I've only got a $5,000 account, and I really don't think I can do this. I mean, I've already made 3 losing trades and I'm $600 down. And I emailed him back. I said, well, look, first and foremost, you're going to make losing trades. Just make sure that when you do make a losing trade, you're not risking any more than 2.5% of the capital. So if I've got a $5,000 account and you're $400 down and still letting the trade run, you're not a good trader. You should cut it as soon as it gets to 2.5%. The second thing I said to him, I said, look, I publicly trade a $5,000 account publicly. Last week, I made 5 trades on that account. 5 trades. 3 of them were in a public seminar in our live trading room. I made it also, of those trades that I made, 2 of those trades were losing trades. But of the 3 that won, I added $2,700 to the account. So I nearly, I added 56% to our account last week because the setups were there. So it can be done. And the more you compound, the more the account grows, the more contract size you can actually trade. So you've got to be able to study and be confident. These 2 things go hand in hand. The more you study, the more confidence you'll gain. I have to say, as a trader, I'm so confident in what I do that I go up in front of trading competitions. I did one in New York, and I'm going to do another one in 3 weeks' time. And I'll trade live, a real account, in front of thousands of people. And you need confidence to do that, because it's when Tom was teaching me, he said, if you ever get to the stage, Gavin, where you're trading live in front of an audience, he said, you're going to feel like the gladiator getting into the lion's den, and they're going to want to see you get eaten, because, and people do. They want to know that even professional traders lose money, and we do. Look, I'm not ashamed to say that there are days when I have losing trades, and I actually learn from them. I don't get angry with the market. I learn from the position. Why did I make a losing trade? I did one on Friday in the live trading room. I traded natural gas. I took a short on an end of a rising market signal, which works 80% of the time. And the very next bar, there was a test, which is a very bad sign once you've gone short, because it means the market's going to go higher. And I almost knew it. I should have gone long. But ironically, I moved my stop down, protected the position. I did get stopped out. My next trade on the trading room was in the NASDAQ. And we made back all the loss and more. And that's how I trade. I don't get angry about a loss. I accept it as part of doing business with the market. You've got to have self-discipline. I can't teach you that, I'm afraid. I really can't teach you how to have self-discipline. There are many courses on being disciplined. Only you know what your strengths and weaknesses are. I have a trading plan, a written trading plan. And in the course that we're doing next week that some of you are on, it's all about how to develop a plan which will help you to be disciplined. I've mastered VSA. I've not tried to find any other methods to complement volume spread analysis. I just use mainly VSA. But are there other methods that work extremely well with VSA? Absolutely there are. We have, Elliott wave works very well. Point and figure charts work very well. So there are other methods that will complement VSA. And there are 2 or 3 of them that I think are very valid. And over the course of 2014, we'll be putting together some mentorship courses on that. Someone said, what makes a good trader? Well, a lot of the great traders that I've met, do use volume in their trading. And many use volume spread analysis, which is what we teach. But you've got to have a desire to trade. You've got to want to do it. It's got to be a passion for you. And the fact that you're in this room would indicate to me that you're passionate about learning, because you're giving up your time on a Saturday for which you paid for to learn. And I congratulate you on that. You've got to be focused. I don't know how many of you meditate before you trade. I know I do. I take 15 minutes of quiet time to focus in and zero in on what I'm going to be doing during my trading session. That's part of my trading plan. And then you've got to understand the game of trading. It's a giant competition with real money involved. And there are some very, very clever people out there who know the game. It's called The Game on Wall Street. And I talk about it in my book. It's knowing when and why you're being groomed to buy an instrument when you should be selling it, like gold. What you should have done in 2011 in August is buy stocks and sell gold. But no one will ever tell you that. The media won't tell you that. You'll never. And in fact, I went on YouTube with that message and got absolutely caned via some very aggressive and nasty emails from people who didn't want to hear the story. Ironically, in 2013, some of those people came back and bought our software. So people do understand the game. They do know that the markets are manipulated. But one of the other important things is belief. You've got to believe in your ability to make money in the market. You've got to believe you can do it. It's the most important part of trading. It's all well and good knowing chart setups, but if you doubt yourself when you're going to push that button, then you're going to lose money. You've got to be confident. You've got to be strong. You've got to be educated. And, I don't need to say anymore. You're here. You're becoming educated. Anything you do in these markets, the reason they say that 80 to 90% of the retail market out there, the retail public, the reason they lose money in the markets is they're uneducated. You've got to have a trading plan and one that works. We're not going to touch on it this Saturday or next Saturday, but if you're in the course next week, we're going to do a lot on. It's all about trading plans. Tom's got a trading plan. Philip Friston's got a trading plan. I've got a trading plan, and that plan is vital, I think, to success. As part of that, you must have good risk management. You must understand the nature of risk. You must know that if you've got a $10,000 account, the golden rule is don't risk any more than 2.5% in any one position. Because if you go and you're losing 6% or 8% of your account and you do that 7 or 8 times, your account's going to blow up. You'll have nothing left. I have never blown up an account, ever, in 14 years. I've always had money in there to get back into the game. You've got to have concentration. You've got to be able to focus. You've got to be independent in your thought processes, meaning don't listen to the media. Don't trust what you read in the newspaper. Don't trust anything you hear on television about the market because it's probably going to be misleading to you. Tom Williams, when he was teaching me, said, Gavin, if I had my way and I was teaching traders, I would lock them in a darkened room with no television, no information at all other than what's on that chart. And that's the only decision they'd have to make, what they see on the chart. They wouldn't be looking at Jim Cramer on CNBC saying buy, buy, buy. They wouldn't be looking at the New York Times or the Financial Times saying that gold is going to go because Goldman Sachs had said gold's going to 2,500. It's all nonsense. The banks have a vested interest because they're the ones that are going to sell to the public. So they will give you, their financial analysts that many people trust will come out with information which is deliberately misleading. I'll give you another example of this. In 2008, I went onto YouTube, the video's still there, and I forecast that oil was going to drop to below $100 a barrel. This was when it was trading at 147. At the very same time I did my YouTube video, Arjun Murthy, the top oil analyst at Goldman Sachs, forecast a super spike in oil, and the oil would surpass $200 a barrel. Now, the truth was what happened. Goldman Sachs began to short oil massively the week after that report came out, and oil dropped from $147 a barrel to 33 in 6 months. You can go and check your charts. That's a fact. When you are a contrarian and you believe the charts, you will learn, as Tom taught me, the chart doesn't lie. You must understand as a human being you're made up of emotions. Fear and greed drive the market. Greed always happens at the top. Just as in gold. Gold had been going up for 12 years. No one thought it was ever going to end. What a great time to sell it for the big professionals. Get everyone excited about gold and tell them to sell their stocks. That's exactly what they did. Follow the system that you personally are comfortable with. You may currently have a trading system that you're comfortable with. That's absolutely fine. VSA, if you're just learning it, I guarantee will complement what you're doing. Because if you get a buy signal from a stochastic, a buy signal from a moving average, but Trade Guide is giving you a sell indication, you'll think twice before buying. But if you've got a buy signal from a stochastic, a buy indication from a MACD or a moving average, and Trade Guide is giving you a buy indicator at that level too, then the probability of that trade going in your favor is much greater. If you're wrong, close your position. That's one of the things Tom always says in seminars when he's talking about my trading. He says the one thing about Gavin, he's not frightened to take a trade, but he's also not frightened to get the hell out when he's wrong. You will never be 100% right in the market. I don't know any great trader who's never ever made a losing trade, and I've met loads of them. I've never met one person who can look at me and say, I've never made a losing trade. Even the great hedge funds that have made brilliant profits also made massive losses. Many hedge funds in 2011 went out of business because their models were geared to a certain type of market. In 2011, 2012, the market was a bull market, and all their models, which were short models to short the market, didn't work. And so they lost millions, billions in fact. So let's get to the purpose of the seminar. Is there any questions so far on what makes a great trader? Do you all agree with some of that? Let's get some feedback. What do you think? And is there anything you would add to that, by the way? Just type in anything you'd add, anything you think would be relevant to that part of the conversation. Let's try and make this a little bit interactive. Is there anything you think would be, what other things do you think are important to make a good trader? Yeah, Tadju says it's a very good point, and I agree with you. And Tadju says learning trading is a process in time. It's like learning a foreign language. It can't be done overnight. I totally agree. I think that trading or reading a chart, you'll hear Tom Williams say this all the time, is like learning a language. I'm trying to learn Polish at the moment. Okay, I'm trying to learn some basic Polish. I can assure you it's not easy. Okay, if you're born in Poland and you're Polish, of course you speak it from birth. You try picking it up from, because I'm going to be spending a lot of time in Poland. And sure, it's very difficult because there's dialects, there's different ways of pronunciation, and it's different. And it's the same with chart reading. Chart reading is a language. Right, let's start with what we call the naked chart, all right, before we go to the PowerPoint. This is a chart of natural gas on the 60-minute time frame. This is a trade I actually took, and I've actually posted a YouTube video, which I'll send you all, where you can see the trade taken and the actual result. So let me just ask you all a question, first of all. What's the first thing you notice about that chart? What's the first thing you notice about that chart? Just type in. What do you immediately notice about that chart? Let's see. Well done, David. You're spot on. Well done, Donald. That's spot on. Good. Well done, Vasily. That's correct. Well done, Pete. That's correct. Okay, so everyone's pretty much typing in the same thing. Good. You're absolutely right. It's in a downtrend. If I put up 200 bars, you can clearly see here from the top, we're making lower lows. Okay. Now we'll start from this bar here. Let's put up 100 bars, which mark the top of that first run. And we started to move down from the 8th, or really from the 7th of January through till Friday here, where we went sideways. Now, one of the first things we want to always do when we're looking at a chart is put in a trend line. Now, I'm not going to spend a lot of time in this seminar talking about trend lines because it's an art form. It's an absolute art form. And we are going to do a course in February on trend channels and trend clusters. So I'm not going to spend a lot of time on that, but I'm going to show you a very simple downtrend channel. Is what you do. We have a drawing tool in Trade Guide, which is in most software programs, where you take the first and the second high that you see on the chart, let go, and it projects a channel out. Okay? You can see that. And I then put on what I call the playing field. And so now I have got a trend channel, okay, and you can see we became vulnerable down here to some buying and we came back up into the channel. Here's what we call an inflection point. That's where the market is marked down out the channel. And this bar here is a very, very key principle that I'm going to show you because it's in a downtrend. Now, in the Trade Guider software program and in the add-in studies that we have two trending systems that are built into the program. Now, at the moment, if I come up here and switch that on and off, if I switch it off, you'll see that the bar colors are blue, means they're an up bar. Now, let me define for you very clearly in volume spread analysis what is an up bar. An up bar is a price bar that has closed, which is that thing there, the close, higher than the close of the previous bar. I repeat, in volume spread analysis, an up bar is a price bar that has closed higher than the close of the previous bar. We're only interested in the close. Forget the high and the low. We're talking about the close. I'll repeat that again. It's very important. An up bar is a price bar that has closed higher than the close of the previous bar. Is there any questions, or do you all understand that, yes or no? Because I won't move on until I get a few yeses. Do you understand what I just said? I know it sounds a bit pedantic, but I had several emails about it, and it's important to what you're about to learn. Okay, good. No questions by the looks of it. All right. A down bar, which in this case, and you can see in this case, the software colors up bars blue and down bars red. That's the standard parameter setting when you click on this button up here in the program. And that's also available in the add-in studies as well. So we know up bars are colored in blue. So a down bar is as we can see, colored in red, is a price bar that has closed lower than the close of the previous bar. I repeat, a down bar is a price bar that has closed lower than the close of the previous bar. And in this particular setting, which is the standard setting in Trade Guider, they're coloured red. So every down bar, which is closed lower than the previous bar, is coloured red. Now, a black bar in Trade Guider, and there's 2, 3, 4 of them on this chart, are level bars. It means they've closed exactly the same price as the bar behind it. So here's the close at 4.186, and the very next bar closes at 4.186. That has a relevance in VSA as well. Now, we have two trending systems that are used in the Trade Guider software program. One is a short-term trending system. Okay, it's looking at a very short time frame. The other one is what we call the medium-term trending system. It's averaged over several bars. Now, if I go and switch this trending system on, which is up here, you will now see that the trend has blue bars or red bars. Red bars are a medium-term downtrend. Blue bars are a medium-term uptrend. Now, these are very valuable when you use them in multiple time frames. So again, I'll ask you a question. What do you notice about this chart and the colour of the bars? What immediately do you notice? Just type in. What do you notice about this chart? Yeah, well done, David. Spot on. You're the first one to answer. Well done, Donald. Just so you know, Donald, you and David answered exactly correctly in exactly the same way. So you obviously two great minds think alike there. Come on, look at the chart. What do you notice about the colour of the bars on the whole chart? 2 of you have got it out of nearly 50 of you. Come on. Well done. Good. Okay, quite a few of you. That's, yes, exactly right. Yeah, well done, Tajus. That's exactly correct. Okay, everyone got it. There are more red than blue bars. Now, the blue bars are very important, as I'm going to show you why in a minute. Okay. Now, let's put something else now onto this chart. We're going to put on the diamond trending system. This is the short-term trending system. Again, I'll ask you the question. If you look at this chart, what do you now notice about the colour of the diamonds and the colour of the bars? What do you notice? Yep. Well done, Pete. That's exactly right. What do you notice about the colour of the diamonds and the colour of the bars on this chart? They match. Yeah, they do in certain places. They absolutely do. That's important. Yep, they absolutely do match. The red diamonds correspond with the red bars as the price falls. Absolutely right, John. That's correct. And that's important. So there's a couple of things that's missing off this chart that the most important part. What is currently missing off this chart that's the most important part from a VSA expert point of view? What's the bit that we're missing? Well done, Donald. That's right as well. What's missing off this chart now? Most important part. Well, that's right, Donald. You're spot on. You're here to learn it today, and you can't see it. Yep. Well done, Lars Goran. Absolutely right. The volume. Yeah. That's done deliberately because I call it a naked chart because I'm building it from scratch. But one of the most important parts is right here at the bottom. It's the most important part of a chart. Now, I want you to remember what I'm about to tell you. Please write this down if you've got a pen and paper. Volume is activity. Write that down. Volume is activity. There are two key types of volume we look for. The first type of volume we want to identify is what we call ultra-high volume. Ultra-high volume. And you'll see at the moment I've got this bar here with my crosshair on it, just here. And if you come down to the right-hand side, you're going to see that the software will read this for you, so you don't even have to guess it, although you can see it with your own eyes, that price bar there has ultra high volume on that bar. But notice it's coloured blue, which means it's an up bar. And that's important because if you've got very high activity, which we have, and the market's gone up, which it has, but the price has closed in the middle and the next bar has closed lower, only one thing can be happening on that bar in that time frame. Supply or sellers are overcoming demand on that bar. Now there's something else, the most important thing, I've put volume on, which is important, but there's something else now missing from this chart. Can anyone tell me what it is? Most important part of what we do. Actually, Lars Goran, that is, I'll define an upthrust for you better, because an upthrust would close on the low. It wouldn't close in the middle, just to be clear. But you'll learn that. So what's missing off this chart now, on this trade guide chart? Anyone tell me? There's one thing that's very important that is missing. We've got the trending system on. We've got a trend channel in place. Something that I haven't switched on yet that I need to. That's right. Well done, Pete. And well done, yeah, Mohammed. The background, well, we for the purposes of this, I've gone back 4 days, which is more than enough for a 1 hour chart because I can see where we're at. But you are right, Mohammed. I do look at the background. We'll talk more about that in a minute. But we're missing here the VSA indicators. Okay, we're missing the VSA indicators. They're not on because I've switched them off up here. This is where you switch them on and off. So what we're going to do now is we're going to switch them on. And we're going to switch the sensitivity of the indicators, because you get two choices here. You have high sensitivity and you have low. The high sensitivity indicators means you get more of them. But if you don't want to see as many and you just want the higher probability indicators, you can just switch that off. And you'll see that in the downtrend, you've only got the red indicators. You haven't got all these green ones. Now, some people tell me, they say, Gavin, the signals are wrong. Because look, Gavin, here you've got a green signal and the price goes down. But it's not a buy signal. It never was meant to be. It's measuring in that hourly time frame imbalances of supply and demand. It's not saying buy because it's in the wrong place. You do not go long on these signals when the diamonds are red. Okay, now here and here, there were strong indications and the market began to change. When the diamonds turned green and the bars started to turn blue, we could start potentially thinking of long trades. But I trade in harmony with the trend, and we're looking for the highest probability entries. Now, the one that you all saw me take, for those of you who are in the trading room and who got our alert, was that signal there, because it was in the right place. The price was trending down. The signal was confirmed. You've got to read the, if you don't read the dialog boxes, you'll never learn. You'll never learn. That's how I learned this. It's the quickest way to learn is open the box. It doesn't take long. You'll recognize they all have numbers. Scroll down, okay, and read what this says. So I see the signal. I read the box. It's an hourly signal, so I've got a whole hour. And then what happens? It says here, if the next bar is down, closing near its lows, this confirms the weakness. So I'm already short on that bar, and boom, I'm confirmed. And I actually got out the trade right there, almost at the bottom. Okay. Now, that made a profit of $1,380 from there to there, with a risk of I think it was $160 was the actual stop. That's a good trade. Now, up at the top, Tadjus, you're saying this bar is red here. Okay, that's because I've switched on the medium-term trending system. If you switch it back to the up bars being blue, like they are here, that's the button you switch. But I've switched on the medium-term trending system, which is built into the software, which colours the bars red, so it's averaging them out. So now that is still a medium-term downtrend, and it didn't change till over here. So it's this button up here, Tadjus, in Trade Guider, which switches that on and off. Some people prefer to just say there's an up bar on high volume, it's blue, with the next bar down, because you've always got to remember, we read the dialog box and it tells us what to look out for. If the next bar's down, closing near its lows, this confirms the weakness. Also, high volume up bars on narrow spreads show further selling. So here, it's telling us that supply is coming in. When we refer to the Trade Guider indicators, they are not buy and sell signals. They are measuring in the time frame imbalances of supply and demand. If there is more supply in the market at that moment, the price will fall. If there's more demand in the market, the price will rise. Lo and behold, here we can see that supply has come in and it's confirmed because the very next bar closed lower. Think about some simple logic here, nothing really complex. The volume on this bar is absolutely enormous. In fact, it's, if we go back, it was one of the highest volume bars for days. And we know its activity. So that means the exchange is getting a lot of orders coming through. Great. So if they're all buy orders, everyone's buying natural gas here, how could the following happen? Number one, the price closed below the middle of the range of the bar. Now, when we refer to volume spread analysis, we're referring to the volume, yes, but we're then referring to the spread of the bar. That's not to be confused with the bid-ask spread. It's the range of the bar. In America, they call it the range, which is the high and the low of the bar. It's known as the range. Excuse my writing, it's awful trying to do it with this thing. Or the spread. Awful writing. That's as good as my 3-year-old writes, but you get the message. It's the high and the low based on the volume. Hence the word volume spread analysis. Now, when we look at the final part of the analysis, after looking at the volume and the spread, the final part is the closing price and the very next bar. You look at 2 bars when you're using VSA. You don't just look at one. Because after the signal appears, it needs what we call confirmation. And that shows you what the confirmation is written in the dialog boxes. What to look out for. What you need to be observing. So ultra high volume on up bars are signs of weakness. And we actually have in the software red colouring with the word SOW. SOW in Trade Guider means not female pig, sign of weakness. Sign of weakness. And the VSA is all about identifying when the market is vulnerable, meaning it's overbought or it's oversold, and then waiting for the trend to change in different time frames. Down here, we have an SOS. Now, it doesn't mean save our souls. It means sign of strength. Here is a reversal. This, by the way, is one of my favourite signals to go long, FYI. You see these reversals, they're very, very powerful, especially when they're tested. But you'll learn about reversals as we go into the principles in part 2. So a sign of weakness happens on an up bar. There's some signs of weakness that do happen on down bars, but they're not many. Signs of strength, they come in on down bars. There's 1 or 2 that this one here, a reversal, happens on an up bar, but it's based on 2 indicators together. When you see a reversal like this, it will very often mark a turning point in the market, as it did in natural gas. Right, is there any questions so far about what I've just shown you? I'm going to wait a few minutes here to make sure you're completely comfortable with those key elements in the volume spread analysis methodology. So is there any questions at all before I move forward? Okay, if I've been clear, then that's great. But I do want to encourage you, if you've got a question, ask it before we get into the actual key principles. So that is the basic software and indicators and what we look for. Now, when the market is in a downtrend, we don't want to be buying the market on a down bar. We want to be selling the market, and we sell it when there's a spike in volume in a down move. These are the best setups possible. Okay, so when you're in a downtrend and the diamonds are red, and if we switch the medium-term trending system back on, and the bars are red, and you see a serious sign of weakness like this happened on a news event, that's the place to look for your shorts, especially when you can see here on this next bar, it doesn't even try and go up, it just collapses. So we're always looking to trade in harmony with the trend. This is the natural gas continuous contract, Pete. Okay, I think natural gas is trading on the G4 at the moment, but this chart I'm using is a continuous contract from eSignal. All right. Any more questions? John says, no, that's very clear and well explained. Okay, good. Good. That's what we're here for. So do you all understand what this chart is telling us? It's telling us that selling took place on very high volume on an up bar, meaning it was marked up deliberately, possibly by the market maker, and the next bar closed lower, confirming the weakness. The market then had a bit of support coming in. There's a green signal. It staggered up, but look, there's no volume as it tries to go up. Then it resumes its downtrend because of what happened over here. And then that bar there, or that bar there, would have been a potential short trade. And just very quickly, because I don't want to spend a lot of time on this, but we have a system here called the H stops. Okay, and if I hit Control D, this is called a chandelier stop. Okay, and this is a stop that basically, if you are trying to find a place to put a stop and you've gone short on this bar, you say, right, I'm going to go short here. You'll see that as the market falls, it tells you to move your stop down. That's exactly how I traded this. Okay, and I actually came out the trade just down here. I didn't wait for the stop I didn't trail it any further. Sometimes you can, and it keeps going. But these are both built into, these little H stops are built into the add-in studies that we have. The chandelier stop is only built into the Trade Guider program, but I use both together. And if you want to be very conservative, you can use the close H. If you're a bit more aggressive and you'd like a trade to run, then you can use this chandelier stop here. And you'll see that this chandelier got hit here. So you would have still made a profit on your trade, but you'd have been stopped out right there. Because as the market went sideways, it was telling you to move your stop back up. I never really do that. I like to move my stop and lock profit in all the way down, because you can always get back into a trade. Okay, good. All right. Let's now talk about the major patterns. Okay, Dan's got a question. How can I apply the same principle on the Asian session with low volume relative to huge on the US session? Dan, in the Asian sessions, and what are you trading? What market are you trading? Are you trading Forex, futures, commodities? Because the Asian session has very big volume in, certainly in, for instance, in, you look at it in the Aussie dollar and stuff like that. The 6A and the 6, well, I trade those, and, you know, if there's low volume in certain sessions, that's telling you something. It means smart money are not active for a particular reason. But I can show you times in the Asian session, especially when the Australian government or the Japanese government makes a news announcement, they make it in their own sessions when the Asian sessions open, and you get massive volume. So if you have low volume in a session, that means something. It's relevant. It means the smart money in that session are not active. You've got to ask yourself the question then, why are they not active? What are they doing? I'll give you an example. There was a trade I took last year on the Japanese yen. There was this really low volume. The market was drifting up. Very low volume, almost nothing. And I thought to myself, something's wrong here. You know, for 2 or 3 days, there was no volume. But then the Bank of Japan made an announcement, and suddenly the volume shot in and the price rallied massively. Now, most traders went long, because I know, because I worked at a brokerage firm at the time. I was in an office with them. We decided that we were going to actually short it because it showed a signal called the end of a rising market. And lo and behold, a day and a half later, the whole thing came rapidly crashing down. So the reason there was low volume in the background is professional money were going to mark the price up, which they did, and it was the Bank of Japan that was very active, and then the price collapsed. Why does the stop move up at the bottom of the chart before you were stopped out? Let me just have a look what you mean by that. Why does the stop move up at the bottom of the chart? Okay, so why does the stop move up? Oh, I see what you're saying here. Why is it going up here and telling you here well, it's doing that because it's recognizing the downtrend, okay, and it's saying if that trend continued, you know, you'd want to continue with it, but it's now seeing this. It's seeing the strength. So it moves it up here, and now the trend changes. So what would happen here is because the trend has changed to green and blue, and we're in an uptrend, you get rid of Control D, and you can Control U, which means Control Up, which means now we've got a chandelier to the upside. So if I wouldn't go long here, but let's say I had gone long here, it would be telling me to put my stop here. Now, as the market moves up, you can see the far H stop, which I use a lot, locks in my profit. All that, in fact, we'd still actually be in a trade. If this was running live, you'd still be in the trade long. And you'd have a reason to stay long because you've got a test there. So, again, on Sunday night, Monday, I may well look for a long trade here to the top of the channel. But I tend to, if I'm going to take a trade, this is an hourly chart, and it's trending up. And you can see we've got these green diamonds and blue bars. I'll go to a smaller time frame, like a 15-minute chart. In fact, let's do that very quickly just to show you what it looks like. And you can see now, here on the 15-minute chart, you can see the bars are blue, the diamonds are green, and there at the end of the day is a signal telling us we should be long on a 15-minute chart. It's absolutely possible that you can have a strong downtrend on a daily chart, a strong downtrend on a 4-hour chart, and then you look at the hourly and the 15-minute and the 5-minute, and they're all going up. That happens frequently. That's because the market is moved by the imbalances in supply and demand. And because the market's fractal, you'll see the changes in trend on the smaller time frame first, but you won't see it on the 4-hour or the daily, possibly for 2 weeks. And sometimes the market gets what we call congested. So it's absolutely possible to trade against a big trend if you've got a principle showing you that there's a reason the trend is going to change, and you're going to learn about those principles now. Lars says, okay, and Dan says, understand I should look for activity days. Absolute. Look for the high volume, and then, as you'll notice in a minute, you look for the same low volume at the same price level, and then there's your trade setup. If there's no volume, don't trade. If it's really low volume, not doing anything, keep away from it. There's other markets that will be active. I always have that golden rule. I look for what we call Yao Ming bars, which are ultra high volume bars. And then I look for low volume bars at that level. And that's how I pick up my trades. So for this session today, we're going to cover the signs of weakness and how we trade them. All right. So everything we're showing you today, Lars Goran is mentioning you have what we call a spring there. That's a word that's used by Wyckoff. We're going to use VSA terms here. But a spring position is what we refer to as either stopping volume or a reversal. That's what a spring actually is. It's a reversal in price. And we have a signal, number 57, SOS 57, one of my favorites. I very rarely lose money on that. And SOS 57 is basically strength in the market, coming in and then springing the market up. It's a very strong one. So Lars Goran, if you've got the software, that's one you want to look out for. SOS 57. It's a good one. So signs of weakness happen on up bars. And I've defined what an up bar is. I'm going to define it again. It's a price bar that closes higher than the close of the previous bar. Now, this next statement really sounds like I'm contradicting myself, but I promise you I'm not. The volume on the bar to show us weakness can be very high or it can be very low. And I'm going to show you why. It's a correct statement. It was the one thing when I first met Tom Williams I couldn't get my head around. He said to me, right, Gavin, weakness appears very high volume, ultra high volume up bars. And then weakness appears on low volume up bars. I said, well, don't be so ridiculous, Tom. Which one is it? And he looked at me and said, well, it's both. I said, well, it can't be both because my brain couldn't get my head around it. He said, yes, it can be both. And it is both. He was right. He was right. Because the ultra high volume is the start of the selling. It's the activity. Then a few bars later, the market's trying to go up. There's low volume because the professional money are not interested in higher prices. Hence, they're not bidding. They're not in there. It's only the retailers that are still buying. Professional money have already sold. That's why you get low volume up bars into areas where you've had high volume. If you ever see a narrow range on a price bar on very high volume, give it maximum, I repeat, maximum attention. You're going to learn why in a minute. Supply in the market or selling will cap any attempt for the market to go up. Ultra high volume up bars are the classic trap by the smart money. Let me show you what I mean. And I mean trap. I'm not going to mince my words here. I mean trap. Because the market, as we know, is done to trap the unwary who don't know what they're doing into a poor trade. Here and here and here, you'll see on these bars the volume is massive as the price goes up. This is the gold weekly chart. Weekly chart, okay, of the gold futures contract. We see here on the 12th of August 2011 a massive spike up, and in fact the following week as well. That coincided with let me just find it for you. So just to sort of reinforce what I was saying to you earlier about what happened with Goldman Sachs, here is the news on the week of the spike in volume. Goldman raises gold price forecasts. Now guess what happens? On that week, price of gold jumps, and these guys look really clever. They look really clever. And it tells you here, Goldman Sachs raised its gold price forecast, citing the fall in US real estates and blah, 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 blah. Okay, thanks very much. Look at the date, August 2011. Look at the date of this price bar here, 12th of August 2011. It's got a big red signal on it, my favourite, and you're going to learn about it in a minute. A buying climax. A buying climax. Look at what happened to gold over the following 2 years. All right, volume is vital in your chart analysis. Volume is the key. And once you see good news, everyone forecasting higher prices, just like happened with crude oil. Crude oil did the same thing. And you see it on a weekly or a monthly or even a daily chart, you know something is going on. Look at where the price closed. And, you know, what happened is so many people began to buy here that professionals just couldn't believe their luck. They bought lower. They were just unloading up here. Unloading. Unloading. And there was a brilliant article that I actually read. I don't know if it's still here, actually. I'll have a look. If you type it into Google up here, is the smart money selling gold? Let's see if it's just trying to find the article. I think I've got it here actually. Let me just have a quick look. I kept it. It was actually a headline in the here it is. I'll let that come up. This is a great headline. It really did help me with my book as well, because I'll let the headline, and I'll let that come up in a second. But the headline was, I think it was something like, is the smart money selling gold? Pete was asking a question about the reversal at the bottom there. It was actually strength in natural gas. It's where I exited my short trade, actually, Pete. So it was strength. Yeah, it was a 2-bar reversal. Look at this. Look at this headline. Right? My book's called Trading in the Shadow of the Smart Money. And there was the headline. Look, it's 7 weeks after they told us to buy gold, and Goldman Sachs are recommending it as a. This is the actual truth. Not many people saw the article, but I've kept it for posterity. I've put it on my wall here. Is the smart money fleeing gold? Yeah, they were. They were. And once you figure that out, you know. So when we see ultra high volume up bars like we saw in gold, it's a trap. Very often a trap, especially if it's on a narrow ranging bar. If you have up bars on very low volume, it tells you that professional money have no interest in the upside. If professional money are selling and the public are buying, which is what happened in gold, higher volume comes in. High plus or ultra high volume on an up bar shows supply. This often means that the herd, the public, who don't know any different, they don't know what we're teaching you here, they're rushing in to buy, their brokers are telling them to buy, the television's telling them to buy, Jim Cramer's telling them to, everyone's telling them to buy. They look at their charts, their stochastic tells them to buy because it's a moving average of price. The MACD tells them to buy, it's a moving average of price. Price has been going up, they buy the top, they get killed. VSA tells you to sell because selling happens on up bars. And VSA will always be right when you see that happening, because if you look at the closing price on the bar, you'll see if it was buying volume and everyone was buying, the price couldn't close in the middle. It's very simple. If you see low volume on up bars, you know there's no interest from the professional money. Always remember, ultra high volume, marked up prices on up bars are very dangerous. Very, very dangerous indeed. So keep that in mind. Professional money like to mark the price up and sell to the uninformed. So let's start with my favourite signal. I do make a lot of money on this. Unfortunately, on Friday, I actually did make a losing trade as well on this signal because it was immediately tested. But it's a very good example of where professional money mark the price up. So it's an up bar. The range of the bar or the spread is very narrow and the price closes on the middle or the low. If the volume is ultra high, meaning noticeably higher than any other bars around it, that is I don't like to use the word a guaranteed sell signal because there's no guarantees in the market, but it is a very strong sign of weakness. Weakness always appears on an up bar because professional selling has to sell into a surge of buying. The narrow spread indicates supply. Something has put a lid on the top of the market. Selling or lack of demand from professional money are the only two things that can do this. If the volume is ultra high, this will show a serious sign of weakness. This sign of weakness needs to have the following. So this is a definition of the end of a rising market indicator. Ultra high volume. It must be, and usually is, into what we call fresh new ground. That means if you look to the left, there's no price action anywhere near it. It's just been in an uptrend for some time. And then often it gaps up. The example that's in my book is JP Morgan. And they did this 3 times on news reports that were bullish. You go and look at my book. It's in there. The news, when you see this indicator, will be good. It'll be very, very good. You'll have everyone telling you, you'll have brokers telling you to buy. You'll have the television punters telling you to buy. You'll read the financial papers, they'll tell you to buy. That's the worst time to be buying because you're buying a market top. The urge to buy will be strong. If you're a VSA trader, you'll recognise this is a great place to go against the crowd. You make money in the market by going against the crowd. You don't become a sheep, you become a wolf. And that's how I think. You act predatory. Just keep away from the herd. If the market is gapped up at near resistance levels in the past, that's also a serious sign of weakness. So here is what it looks like. The news is bullish. Okay, now this is an example from my book. I use it because it's a great example. It was 2009. This is one of the stocks that I specialise in. And the news was very, very bullish. JP Morgan scores big in latest quarter. Banking giant enjoys rebounding key areas such as investment banking, even as the consumer credit issues persist. Great news, everyone. Buy JPM. But what do we notice here? On that same day, boom. We jump up, look at the spread of the bar. Very, very, very narrow. All right? And there's no price action up to the left. It was into fresh high ground. The next day, we close lower. Look at the volume. Absolutely enormous. Now, think about this principle and just learn this at the top and bottom. And you could make a lot of money on this signal. Just this one, not any others. This one at the top, and there's another principle at the bottom, which we call bag holding. Now, first and foremost, the spread of the bar, unlike other signals we have, is very, very narrow on high volume. That is very important to you. That is a clear telegram from the smart money that they're selling into that bar. Because you look at it, number one, it's a narrow range or a narrow spread. Number two, it's closing in the middle. And number three, the next bar's close lower. Now, only one thing can happen. Supply, selling, is coming in. So for every buy order from the public who've just seen this news, they imagine you switch on CNN or you switch on the news and suddenly the reporter's looking at you saying, we've just seen from the New York Stock Exchange floor, everyone's buying JP Morgan. Look at their results today. Absolutely brilliant. They've scored big. And you look at the price go up, human beings or traders who don't know any different cannot resist the urge to get in there. And worse, if they bought lower, they start adding to their position, thinking they're clever. But unfortunately, as we see, boom, the price collapsed. Absolutely collapsed. And they do the same thing, okay, at different, $49 for JP Morgan was key. And this is what happened. There was a key resistance level. This was the old resistance. And we're back up there where the end of a rising market signal appeared, look, right up at a resistance line. And that is very, very key. Now, when you see the end of a rising market, Tom Williams would just short instantly. Probably doesn't wait. But what I've learned is you're much better off waiting for the market to actually roll over, almost like the top of a mushroom. So it looks a bit like this. If I was to draw it, let's say you've got your very high volume bar here, and there's your narrow spread. After you see it, remember the price has been going up here. The market will often go sideways. It may even go up again a little bit on very low volume. But what I wait for is the price to start coming down below the low of that end of a rising market signal. The minute it triggers below it, the first bar that's an up bar on low volume, I short it instantly. Don't even hesitate. It's a very, very strong principle. So I like to wait for the mushrooming over of the market. That's a good example there. Look, you can see here's your end of a rising market, and we start to trend down here. And if you put the diamond trending system on, you'd find that after that signal, you get red diamonds coming in here, and I short on the third or fourth red diamond. All right, any questions on the end of a rising market? Any questions at all on that principle? It's very easy to see, and better than that, we've got a scanner that finds those for you, which is even better. Okay, I can see some people typing in some questions, so I'm going to... Okay. No, this isn't, John, this is not like an upthrust, no. The reason it's not an upthrust is because of the spread. Upthrusts have wide ranges on the bars. This is the narrow spread. It's the most important part about it, the narrow range on the bar. That's the most important part about this. Okay, good. I'd say the probability of the market we've back tested this actually using the Infinity AT charting platform. Just this indicator alone, it had 86% accuracy rate when it was back tested. I don't like to say that I don't like to give percentage accuracies, but you can back test this indicator yourself. If you're using the Infinity platform, you can actually put the indicator in and back test it, and you'll see it's incredible. Just believe it for yourself. It's about 86% it was accurate, meaning that after the signal appeared, the market fell within about 20 bars. So it's very accurate. And here you can see, after you see the signal, you'll often find the market just collapses, which it did here. See here, just fell. But then if it does rally, it goes up on what we call no demand. Look at A and B, they've marked the price up, but there's very low volume at that price level. As it reapproaches the area where there was the selling, we get more weakness appear. Okay, and let me just see if there's any more questions. Yeah, when you see this proves the point actually, Phil, that when you've got ultra high volume like this is often what happens after you see that signal, especially on a big time frame like a 4 hour, a daily, a weekly. Yeah, you do see these on 5-minute charts. They still work. You do see them on 5-minute charts, even 1-minute charts. You'd be amazed. On a 1-minute chart, I've seen the S&P get marked up on the end of a rising market and immediately fall. It's a great scalp trade. Wouldn't be in it long, but you definitely would get a few ticks out of it. Now, Tom has a very simple trending system that he uses to stay in a trade. So let's say he's gone short on an end of a rising market or a buying climax. He looks for that no demand bar, and then he waits for 10 bars to see the result of the weakness. Now, when the trend begins, this is what you should see, okay? By the way, you're all going to get a copy of this PowerPoint. Yes, you will. Yeah, you get a copy of it. In a strong downtrend, we should see increasing volume, not excessive or high, on the downside, and decreasing volume on the upside. In the downtrend, you can allow for a couple of up bars, 2 of them, if they're on low volume. So as it's trending down, you can allow for 2 up bars. You completely ignore, as though they don't exist, any bars that close level, if they're those black bars I showed you earlier, or near to those. That's a bar that's closed near or level with the previous bar. The end of the downtrend is seen by 2 consecutive up bars followed by a test or a no supply bar. This is very similar to what we saw in natural gas. So here's a downtrend, and you can see we have 2 up bars, but they're low volume at point A, so you can stay short. Again, at point B, we have 2 up bars, but they're on very low volume, so you stay short. Here at C, D, E, and F, the market's gone up. We've had 1, 2 up bars, but we've had 2 down bars, and the volume has increased, but the ranges have stayed narrow. So again, you wouldn't, if these had closed up on the high, and then you had a 3rd consecutive bar, you'd have closed the position out. But in this instance, you stay short. You have 3 more down bars, down bar, down bar, down bar. Then you have 1 up bar, but again, the volume's less than the previous 2 bars. We call that no demand. You stay short. Then we have a down bar, 1 up bar, a down bar, 1 up bar, a down bar, a down bar, 2 up bars. Remember, you can allow for 2. We don't have a 3rd up bar. You get a down bar, so you continue with your trade. Down bar, and so it goes. Most traders tell me that when they're in a position, they're so frustrated they get out too early. I use this trending system on Thursday to trade that natural gas alert. I'm going to send you all the videos. Can I just ask everybody actually in the room, how many of you, just type in yes or no, saw the trade on natural gas on Thursday? I did actually put it on YouTube, the one I took on Thursday. Did anyone see that? Because that's a really good lesson if you haven't seen it. Yeah, okay, so most of you said yes. Okay, yeah, okay. I'll post it at the end here so you can actually go and take a look. Before we leave, I'll send it to you. I use this exact trending system that I'm showing you now to let the market fall. And it works so well because once you're short, I was tempted to take profit around $400. And I thought, stay with your belief in this trending system. The market went up, and from my $400 profit, I was now up to $200. I thought, oh no, it's going to go against me. I stayed with the trending system. Without, 15, 20 minutes later, I was $600 in profit. I'm like, this thing's going to go. And it kept going until we saw what we call a selling climax. And boom, that was it. We were back in profit, and it ended up what could have been a $300, $400 profit was now nearly $1,400. So again, here you can see, here's your weakness to the left. You take your trade, and again, you can see from here, you have a down bar, you have 2 up bars, low volume again, and down we go. Okay, and these slides are all annotated for you, so when you've got the actual slides, you can print these out and go back and study them for yourself. One of the best ways to learn. And when we've uploaded the archive, which will be on Monday for today's event, because it's got to be uploaded to the server, we'll post to you, we'll send in your customer-only area of the website, we'll post everything for you. Okay. No demand at market top. I'm going to overrun a little bit here because, and we'll take a break at about, if it's okay with you guys, in about 15 minutes, because this no demand with the end of a rising market, I want it to flow through before we take a break because it's one of the it's one of the best setups. So if you're all okay with that, I'm going to just overrun a little bit here. So markets, as we know, are constantly being traded when they're open. A sudden down move will lock many traders into poor positions as they wait and hope for a rally to get out with little or no loss. If after a reaction the market then starts to go up, any old resistance levels to the left will require effort to go up and through these old highs because they have to overcome the selling from these locked-in traders. To approach an old high on low volume and narrow spreads indicates that the old highs are not going to be penetrated because there's no demand. A market will not rise when there is no professional interest to the upside. And this is what it looks like. This is what happened in the weekly chart of crude oil, actually. This is actually Apple, the stock. And you can see on 2 occasions it goes up and makes a double top. But look at the volume on these narrow spreads up here. That's what we call no demand at market top. It's where the market has been marked up by the market maker, but professional money, as you can see from the volume, have got absolutely no interest in higher prices. So they actually decide to close out. Now look, this chart was from 2008. Look at where Apple was now. Look, crikey, see how much you'd have bought Apple down here. You'd have done very nicely, wouldn't you, over the last few years? And a lot of people have. So no demand is always defined as an up bar. Volume will be less than the previous 2 bars and a narrow spread on the bar. Okay, so no demand is defined as an up bar, the volume is less than the previous 2 bars, and the spread of the bar is narrow. Here's another example here, as we can see. You can see it's an up bar, spread is narrow, volume less than the previous 2 bars. And that is what we call no demand. Here again, we can see no demand at a key level, and very often if the next bar closes down, we get confirmation. If you ever see a no demand bar, and the market's going up like this, and the next bar closes higher than the no demand bar, it means it's not been confirmed. So ignore it as though it doesn't exist. You need the next bar to close lower than the no demand bar, like it does here, collapses on the low. And that's what I call a gotcha bar. And those, so you're always looking for confirmation. Remember, I mentioned that after you see a VSA principle, look to the next bar for confirmation. And again here, you can see at a resistance level, the market goes up, but at point B, no demand. At point A, you've got your ultra high volume up bar and confirmation at bar B that there's weakness there. Bar C closes just below or level with the no demand bar, which means it's confirmed. If it closes level, it still means it's confirmed, and down we go. And you will see this set up almost every day in the markets. You'll see this set up. Very, very interesting. So again, after I've seen a no demand bar at the top of a market, I never go short. I wait. I wait. It's exactly the same as the end of a rising market. Wait for the market to roll over. Remember, you don't know if it's the actual top until you see a good change in the trend. You do not go short on no demand bars if there is an uptrend still in place. Be patient. These bars are far more powerful places to short when you have a serious sign of weakness in the background, such as what we call a buying climax or the end of a rising market. So if you see ultra high volume up bar, massive volume, and a few bars later, a no demand bar, get ready to short because the market's going to fall. Well, any questions on no demand at market top? Let's just see if there's any questions. I'll give you a couple of minutes to type it in. Well, let me ask you all another question then, just to be sure. Am I explaining this clearly to you? Are you understanding this? Just type in yes if you're actually getting this, because that's important to get some feedback. And yeah, if you're I mean, I'm trying to make it simple, but good. All right, that's fine. Good. Okay. Thanks for that. I mean, that's important because I don't want to lose anybody. I know some of this can appear complex, but I'm here for you. If you've got questions, you can email me. No problem at all. Okay, Dan's saying I was following MCK stock and looking a few weeks ago at no demand, but it just got an upthrust this week. Can you take a look? Sure. Yeah, I'll do that before we take a break. Let's do that. MCK. Okay, it's a US stock, right, Dan? David says, if you see a no demand on a 15-minute in an uptrend, would you go short in a 1-minute chart when you see a change in trend? Not on no demand, I wouldn't, David. No. If I saw on a 15-minute chart an ultra high volume bar, like an upthrust or a end of a rising market, I would definitely look to short on the 1-minute, 2-minute, 3-minute chart, but I wouldn't do it on no demand. It's not a powerful enough signal for me. I like to see the ultra high volume coming in on the big time frame, and then you go to the small time frame. And then I'll give an example. If you saw an upthrust on a 15-minute chart, the 1-minute chart would have been going up with it because it's an upthrust. It's been going up. But when the upthrust closes on the low of the bar on the 15-minute chart, jump down the smallest time frame you can, a 3-minute, a 1-minute, and look at the trending system change. If it starts to change to red, you know that upthrust is more selling than buying. The first no demand bar that you see on that 1-minute chart or the 3-minute chart, that's a great short trade. That works very well. Okay, let's go and before we take a break then, let's this is for Dan. He's asked to go and look at a US stock called MCK. May already be in my... No, it's not. Oh, by the way, just one for your watch list, everyone. LSI. Okay, I'm not sure what's going to happen with this, but I'm watching it. But you've got supply coming in here, and behind that, the end of a rising market, and it's just knocked it sideways. But there's been some news about this LSI Corporation, but that's very unusual for that to happen. I know there's some sort of buyout going on, but I'm suspicious of the news, so just keep an eye on that one. Okay, MCK. Right. Right, well, first and foremost, I wouldn't consider shorting that at all. Okay, I wouldn't even consider shorting that because it's in a strong uptrend. So the bars are the diamonds and the bars are telling me that that's trending up. And if that volume is high volume, if that's tested, that could easily go higher. That's a strong stock. That's not a weak stock. Now, interestingly, on this bar here, you've got two very weak bars. So you've got to watch this now. That is climactic. I mean, I would be very surprised if that doesn't come back down next week. I would be very surprised. It's still in an uptrend. Here's how I would trade this. You mark the bottom of the climactic bar. Okay, this is exactly how I sell stocks. If I'm going to options trade this, and we're going to sell some puts, here's what we do. You wait for the market to come back down, which I think in this one it very likely will. That is climactic. Okay, you've got two climactic bars. Be aware, if that's absorption, there'll be a test here, and I'm going to put this on my watch list now. Thanks, Dan. It's a good one actually. If it tests, it could easily go higher because remember the parent index is in an uptrend. But I suspect that if this is genuine selling up here, I think there's definitely some weakness there. We should come back down. Now, if it comes back down and breaks this bar, so the price goes through it, the first no demand bar at that level at 165 would be a short trade. Yes, I would. Even though the trend is strong, it would be it's due a pullback actually. Look at the weekly chart. I mean, how many up bars has this had? Up bar, up bar, up bar, up bar, one down bar test, up bar, up bar, up bar, two down bars, so it's still an uptrend, up bar, up bar. See, you take Tom Williams' simple trending system just from here, right? So remember the blue bars are up bars. You've got an up bar. In fact, we can show it simpler here though. Okay, so looking at a long trade here, every down bar is red. Remember, you can allow for up to two red down bars in an uptrend. This weekly trend isn't broken because you can see an up bar, 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 one down bar, volume not particularly high. Then you've got an up bar and one down bar, up bar, one down bar, up bar, up bar, up bar, one down bar, up bar, up bar, up bar, up bar, up bar, 5 up bars in a row. One down bar, it's testing, it's low volume. Up bar, up bar, up bar, 2 down bars. That's the only risk. Then you've got an up bar, you've got 2 down bars, but look at the volume, there's no selling pressure. Level bar, pretty much, or slightly down. Again, the volume isn't high. Then a massive surge up, closing on the high on the weekly chart. So yes, I think it's definitely a pullback trade, but I wouldn't really want to say sell that stock yet. Does that make sense, Dan? It's trending up is what it's doing. Don't try and be brave and pick the top. I tell you, we have a scanner, which maybe I'll show you next week, where we can find stocks to short in a bear market and stocks to buy in a bull market. I would be staggered if this stock did not come out as being one that's stronger than the parent index. I would be staggered. Definitely. Okay. That's a pleasure, Dan. No, that's what we're here for. You know, mate, you got to, I mean, it's like this particular stock, LSI, you don't see this happening very often where you get just a gap up on narrow spread. But you see, for me, I wouldn't even consider shorting this or even thinking of selling puts until these diamonds have changed to red. The market has to come back down to $10 to even consider a short. But if it does, I've had several people emailing me about this stock because there was a news event, there was a buyout or something. But nevertheless, if that was really bullish, we wouldn't have staggered sideways for a week. So something's going on. All right. Okay, let's take a break then. Sorry, I overran a little bit. Let's take a 15-minute, actually, let's take a 20-minute break. Let's just to refresh ourselves. I'm going to overrun a little bit tonight. I hope you don't mind. There's a lot still to go through. I'll try and get you out by, if we start again at 10 to 5, I'll get everyone out by say 6:05. So 6:05, 5-minute overrun. Okay, and we'll take a break now then till let me just pause the recording right now. Hello everyone, welcome back to part 2. We're going to continue with the signs of weakness now, and principle 3, which is no result from effort. This particular setup looks very much like an upthrust, but it's really based on the laws that drive the markets. There are 3 universal laws that are governing how we read charts. Most of us have heard of supply and demand. That's a law, the law of supply and demand. But there is another law, cause and effect, and then a third law, effort versus result. Everything we see in the volume is all about the effort to push price up or down, and the result is seen in the closing price on the price bar. So this particular indicator that Tom developed is called no result from effort. Any indication of strength in an uptrend, you should expect a strong market. If the next bar is down on a wide spread closing on the lows, and the close is lower than the previous bar, this is what we call a countermanding signal. You do not fight the market, but you have to assume that there's been no result in an effort to rise. Therefore, the market must be weak at that time. If the original indication was genuine sign of strength, then professional money would immediately move into the market, giving higher prices, not lower. So let's see what that actually looks like on a chart. So when we have, this is sign of weakness number 67. Now we're referring to this indicator just here. Now what happens is we have a down bar, okay, which is followed by this up bar, following an up bar behind it. So you get this widespread up bar, but the next bar here produces this signal number 67. There's actually several no result from efforts. Now they're very similar to upthrusts. Okay, they're almost. I mean, I actually said to Tom, why don't you just call it an upthrust, because that's a hidden upthrust. But the reason that Tom had a special signal for it was because of the bar behind it. All right, and that's the reason why it's got a different description to it, because the market here is being artificially marked up, hence the high volume. But this next bar is important because it's closing within the body of this bar, and that will knock the market sideways and indeed down, which it did over here, because it's telling us that here there was effort to push the price up, but the result on the next bar was a close lower than the close of the previous bar. If you ever see that setup, the market's going to go sideways or at best fall, but mostly you'll never see it go much higher, because you're seeing on that high volume the professional money are busily selling into that bar. But again, I will caution you, the news here will be good. And if you're using a stochastic, a moving average, anything, a moving average of anything, especially price, you'll be getting buy signals here from your technical analysis. And that is the problem with traders that are just using mathematical technical analysis and not volume. They're getting signals in the wrong places, which is why they lose money. When you use volume analysis in your charting, you get the whole picture, not part of it. And that's why volume is so important. Here you can see again, at bar A, the market is marked up. Bar B, we have still very high volume, but look at where we close. Bottom 50% of the bar, and within the range, the high and the low of bar A. And then at bar C, we have the same thing. Okay, bar C is confirming that there must be more selling in the volume behind it, and you can see what happens to price. And these are actual examples that we traded. So when you see no result from effort, you're seeing very clearly that volume is trying to push the price higher, that there's sellers at that price level. And you can see in the closing price is very important. If you look at bar A, we close in the middle. This is the daily chart of British Airways, a UK stock. Bar B the next day, we have still very high volume, but we close below the middle. And bar C is the clue to short, because even though the volume's low, it's closed lower than bar B. Now just study those 3 bars. If you see that and the news is good, it's a great opportunity to short the market, because you're seeing what we call an artificial markup, done quite deliberately by the professional money, are fully aware that they want to unload their holdings, and most of these type of indicators come on very, very good news. Okay, now often you'll see after that type of activity this happen. No demand, which we'll talk about in a minute, which is where the market goes back up into the body of these bars, look, and the volume is now very low. So there's the closing price, look. Look here. As we see, the price goes up, the volume diminishes as we go back into this area here. And that is simple because if professional, this proves my point at the beginning that you can have ultra high volume bars that are weak and you can have low volume bars at the same level that are weak. Happens all the time. And boom, down we go. That thing, I think that went down to about 120. Okay. Any questions so far on that chart? Let's get rid of, we just move it back. Okay. Okay, any questions at all so far on no result from effort? Very, very common thing to see, especially we see this at resistance levels. You see this this setup very commonly at prior resistance levels. This actually marks often a double top. Okay, I can see someone typing in, so I'll just wait. Okay, is bar B an upthrust? No, it's not. An upthrust, which we'll come to, a genuine one, would do this. It would start its journey up here like this. So it wouldn't go into the body of the bar. It would just take off and close there above the top of that bar on very high volume. As you'll see in a minute. There are two types of upthrusts. If you read my book, you'll see that you have what we call the hidden upthrust and the upthrust, but both of them are serious signs of weakness, let me be clear. We'll come to the upthrust in a minute because that's going to be an important part of this presentation. So, after you see no result from effort, what's it telling you? It's telling you that professional money have no interest in the upside. Hence the word no result, meaning it hasn't closed on the high, there's been a lot of volume, the price has closed on the low. This particular signal usually appears after the market's trended up. But I can tell you something. If you see this signal in a downtrend, short it immediately. You don't see it very often in a downtrend, but I shorted it 2 weeks ago, just before, in fact, it was 3 weeks ago now. It was just before my birthday. I had a trade in the euro. And it was a downtrend. It was on a daily down move. It's a 5-minute chart, and the setup I just showed you hit the top of the downtrend channel. I couldn't believe it. It was a perfect setup. I went short, just one contract on the small account. 60 ticks later, I took my profit. It just moved that quickly, and it was within 15 minutes. It just took off to the downside. It's a very strong principle. I don't like shorting it in the uptrend. I wait for the market to roll over and then look for no demand. I tend to be a trend trader personally, but this doesn't mean we haven't got customers and people that trade with VSA that will short this immediately because it's a strong principle. You usually see this at the top of a trend channel. This is where this principle appears because the market becomes what we call oversold or overbought. And when it's vulnerable, okay, and it's oversold, for instance, or overbought, you'll see these type of principles appearing. The no result for effort actually has a bottom reversal, which is the sign of strength. It's the opposite of this no result from effort. Okay, so let me just make sure. Is there any more questions on no result from effort? Yeah, Phil, at the end here of this, I'd be happy to go and look at some of your charts and some of the charts that what I'm hearing here is a couple of you have got principles that you've seen on charts and you'd like to have a look at them. I'm happy to do that. Not a problem at all. Yeah, let's wait till we finish these principles, and providing there's time, well, if you've got any particular charts you want us to look at, then by all means let me know. Okay, good. Now, the upthrust. There's a lady called Rita Offen. Some of you may have heard of her. She works with Tom Williams, and she helps run the VSA Club. And I affectionately call her Mrs. Upthrust because she trades this signal so successfully and so confidently that she makes a significant amount of money each week. And Tom sometimes refers to her as a housewife, which because she's got 4 kids. Now, okay, she doesn't work as such. She's got a part-time job, but she makes a lot of her money trading the markets using this principle. And it's one of those principles that when you see it, you know it's a stop gunning maneuver by professional money. So upthrusts are there for a very good reason, and that is to trigger stops, especially if the market's weak. There are, however, times when you see what looks like an upthrust, but the market doesn't fall. And I'm going to show you where those look like it, and you shouldn't short them. The upthrust has to look right. It has to be in the right place. Many are created in a strong market by gapping up at the opening, then falling off for a rest, only to carry on up. The genuine ones are easy to see. You should have signs of weakness in the background, not signs of strength. Now, I tell a story about the polar bear in Hawaii and the polar bear, I think it's in the Antarctic or the Arctic, someone can correct me there where they live, but I'll say the Antarctic. But if you were walking around Hawaii, you went to sit on the beach, sun was out, you're enjoying your cocktail, and suddenly you turn around, there's a polar bear walking towards you, you know something's wrong because you don't expect to see a polar bear walking down the beach in Hawaii. It's in the wrong place. And either you've had too many cocktails or the polar bear escaped from a zoo, but it's in the wrong place. That happens with upthrusts, you see. But if you're in the Antarctic and you're walking along and you see a polar bear, that's where you'd expect to see it. So it's the same with an upthrust. Questions come in from Mohammed, and he says, what's the difference between no result from effort and the buying climax in structure? You tend to find a buying climax has much higher volume. That's the first difference. And the range of the bar will be slightly higher, usually. But most importantly, a buying climax will close in the middle, where no result from effort will close on the low, Mohammed. Let me repeat that to be specific. When you see a buying climax, the volume will be absolutely enormous. I mean, on no result from effort, you can have those on high volume. You do see them mostly on high volume or ultra high, but it closes at the bottom 25% of the bar on no result from effort. Buying climaxes tend to close in the middle of the bar, and the volume is enormous. I mean, well, we'll come to it in a minute. It'll jump out at you. Does that answer your question, Mohammed? So the blind climax, yeah, okay, good. You'll see. We'll come to it in a second because I've got a slide to show you that. So here we have, okay, what we call an upthrust that's in the right place. All right. So the upthrust is in the right place. Sorry, let me just switch my Skype off. I didn't know that was still on there. Just bear with me. Okay. Now here, first and foremost, you have to have weakness in the background. What do we mean by that? Ultra high volume up bar. That is a climax. That one there. It's a climactic bar. Look, massive volume closing in the middle. That is a buying climax. And over here, the market staggers sideways because of all the selling. So we never ever, when you see a bar like that and you want to short it immediately, you put a stop on the top. That's it. It very rarely goes through it. But the volume has to be massive. Okay. The market staggers sideways. Now suddenly here, this is what we call a gotcha bar. All right. It's a sign of weakness that's on a down bar because it's take all the people that are long here that are still holding on thinking it's going to be a great trade. Boom. They're now locked into a poor position. The market then goes up, but this is what we call no demand. Look, there's no low volume less than the previous two bars, clear no demand, weakness in the background, bang, the market falls further. So two bars have locked traders who were long into an awful position. Then the market here gets marked up. Here we have an upthrust. Now it's on quite light volume. Now the upthrust can have two types of volume on it. It can be average, low, or it can be, three types of volume. Ultra high, average or low. It doesn't matter. It's the closing price of the bar that's important here. And most importantly, notice that this price close is within the body of the bar behind it. We call this a hidden upthrust. Don't get too wrapped up in the terminology. An upthrust is a sign of weakness. And the next bar must close lower to confirm it. Okay, so always remember, after a sign of weakness, you want the next bar to close lower. Okay, that's what you really want to see. If it does close higher, it should close higher on much lower volume. But overall, most of the indicators require the next bar to close lower for confirmation. This is a great opportunity here. Look at the volume on this upthrust, and it's in the right place. This is actually a gold chart from March of 08. And what had happened here, the market was ramped down. So this was what we call a gotcha bar, right? So they just marked it down. It went back up into the body of that bar, look. Volume increased, closed almost level with the close of the bar. Again, we call that a hidden upthrust. And that is a serious sign of weakness. Now, I will say this. The higher the volume on the upthrust, the more powerful the signal. So if you see volume like that, much higher than the previous 20, 30 bars, you better be looking for shorts. You better be looking for shorts. And again here, we close lower than the upthrust bar to confirm it. And we know that gold actually went all the way down from here. That marked here, it didn't ever go any higher. And a great place to put a stop is just above the upthrust. Right above the upthrust, just about 5 or 6 ticks above it. Because very rarely after an upthrust will you get a secondary upthrust. And these are very powerful. I mean, again, when you see them, they're very obvious and they're very clear. But you've got to have some sort of weakness in the background, which we have here. And as it happened in this instance, we were in a downtrend. Now here, you see this bar here, that looks like an upthrust, doesn't it? So there is a polar bear, but it's in Hawaii. It's in an uptrend. And there's no real weakness around. This is in a downtrend. The market's been pushed down, and there's weakness on this bar. Okay, look at the volume on it, and it's closed on the low. This is one of the few signs of weakness that has a close on the low. Okay, that would produce a signal called no result from effort, which we just talked about. And there's the upthrust into the body of that bar. This is what we call a genuine upthrust. That's what it looks like. At bar A, it's called a hidden upthrust. At bar B, that's what we call the genuine upthrust. Okay, and we look at this because the volume is so low, we call that a no demand upthrust, because the volume there is so low, there's just no interest in higher prices. And so the volume's low, and as the clue is, the bar starts its journey from the top of that bar. It never goes into the body of the bar. That one there is in the body of the bar. Hidden upthrust, bar A, genuine upthrust, bar B. But don't get too wrapped up in the terminology. They both have the same result on price. They're weak bars. And often you will see an upthrust, and a few bars later they'll do the same thing again. So if you're short an upthrust, you should always use a trailing stop, because they're very likely to come up and get you again. That's how it works. Mohammed says, can we call this second bar here a secondary upthrust after distribution? Well, you're obviously very good, Mohammed, because that's exactly what it is. There's your distribution. You're absolutely right. And there's your upthrust into the distribution zone. So you're very advanced. That's very observant. That's exactly correct. That is a secondary upthrust into distribution. The distribution happened where the yellow box is. And when I haven't referred to that yet, but because I was coming to that later, but as it's been brought up, the market works in two ways. You have accumulation, which is buying, and you have distribution, which is selling. Selling happens as the price rises because professionals have to make a profit from what they bought lower. Most retail traders don't understand that. They think as the price goes up, they should be buying it, and many of them do and get caught. So this is an upthrust of a distribution area. If you've got an ultra-high volume bar like this in the background, and then at bar B, you see the upthrust into that area, it's almost an immediate short. You don't really care about trend at this point. And as it happened in this instance, the whole stock collapsed after this secondary upthrust. Timing is everything in trading. You could be short on this upthrust only to find that this one stopped you out. But Tom taught me, don't be frightened to get straight back in if that happened. But if you were going to trade this upthrust here on bar A, you'd put your stop above the high of that bar there to cover yourself. Okay, because if you've entered on this bar, now that stop wouldn't be too wide, and then as the market fell, you try and get the stop to break even as quickly as you can, so that if you do get stopped out on that, you don't lose any money. Okay, let me just see if there's any questions. Mohammed, that was a good observation. Any questions at all on that chart? This is a very important part of the presentation on upthrust, because they can make you, if you understand them and you practice looking for them, they can make you a lot of money if you know what to look for. Because it's the market is being moved deliberately against you when you see an upthrust. And if you trade in harmony with them, you'll be shorting at the right moment. Okay, I'll just see if there's any questions at all. Okay, and here's the rule for shorting. And there are all rules that you should observe. This can and does appear in an uptrend, but it's not a genuine upthrust because you're in an uptrend. It's a far more powerful short in a downtrend. Do not short an upthrust in a downtrend. It's in the wrong place. This is a powerful short when there is a downtrend in place and you see this push through the top of the trend channel, especially the downtrend channel. Look for signs of weakness in the background. Now, there's a video that I produced with a trade setup in Microsoft, and I'm going to show you where you can go and view this afterwards. If you go to www.tradingthemarkets.com, which is our alert service, and what you'll see here is example alerts, and if you click access on any of these buttons, all these videos work, okay, because we've actually got them working, so you can actually see them even if you're not subscribed to the service. And if you go and have a look at this one here, Microsoft, I gave a short trade in August, the day they announced that Steve Ballmer was going to resign, and the price was marked up. And if you click that, and I won't play it, that is a classic example there, classic example of the upthrust and how it's used. It's probably the best video that we've got to explain it. I'll just put it in the room there. Really clear, really specific as to what that is actually doing. It's showing us there. Sorry, the website again is this. Sorry, I was a bit quick. Just take that out. It's just www.tradingthemarkets. This is a different company to TradeGuider. It's a different firm. But what we have is a panel of experts, including myself, that we send out trade alerts as they're happening by email. But if you click on that button there, what you're going to get is all the videos of the alerts that we sent out. They're all date stamped and time stamped, and we trade ourselves many of the alerts in our fund, so you can actually see those. And then there's a video here which explains what that does. So that's the website, John. Okay. So just recap on this. After you see an upthrust, it can and does appear in an uptrend, but it's not a genuine upthrust because you're in an uptrend. It's a far more powerful short in a downtrend. Do not short an upthrust in an uptrend. It's in the wrong place. This is a powerful short when there's a downtrend in place, and you see this push through the top of the downtrend channel. Look for signs of weakness in the background, and in fact, Mohammed got it right when he said look for distribution in the background. Look for the ultra-high volume bars to the left of you, and then look for this upthrust. It's in the right place. Any questions on the upthrust? Before I get to one of my favourite setups, another one. Okay, so far it looks like I've got no questions, so I must be explaining this correctly, which is good that people are understanding it. Okay, so the next principle is one, well, in natural gas on Thursday and Friday, you had this principle. A downtrend with no demand appearing. This is a really strong indicator. Remember what a no demand bar is. It's an up bar with volume less than the previous two bars. This indicates lack of demand from the professional side of the market. It's important that this principle called no demand is on an up bar. Remember what an up bar is? It's a price bar that's closed higher than the close of the previous bar. And for the best short, it should appear after a major sign of weakness and in a downtrending market. And what do I mean by a major sign of weakness? I mean a buying climax, which we're going to come to, the end of a rising market. Those are, or what we call climactic action. Even a high volume upthrust would be considered, an ultra high volume upthrust would be considered a serious sign of weakness. After seeing a no demand bar, do not sell at market, but wait and place a sell stop below the no demand bar. Can anyone tell me why? Have a guess. We do not just immediately short on no demand when we see the bar. Why would we wait? Based on what I've been talking about today. Let's see if anyone's awake still here. Why would we wait? You see no demand. Why would you want to wait? Just type in what you think. Well done, Pete. Excellent. Okay, so far 2 of you have typed it in. Well done, Philip. Think about what I've been saying about after a signal, what do we need? We need something to happen. Confirmation. Well done, Donald. Exactly right. We're waiting for the next bar to close lower than the no demand bar, confirming the signal. And if you read any of the dialog boxes in Trade Guider where we see no demand, let's have a see if we can see one. No demand. The next bar should close lower, and the market did go lower. Not very much because it's in an uptrend in that example. See if we got any no demands here in a trend. Well, there you go. And it knocked the market down. It's in an uptrend. I wouldn't ever short that, but if you read the dialog box, yeah, everything tells us. It's all the secret of VSA is in those dialog boxes. No doubt about it. Everyone I've met who's done really well with VSA has read the dialog boxes every single day they've been trading and they said it's the easiest way to learn. I'd agree with that. So, no demand. Okay, we can see here you've got weakness, the market's trending down. Always remember the volume will be less than the previous 2 bars, and it's an up bar. And there's the volume, less than the previous 2 bars. And usually the spread, well, always really, the range or spread of the bar will be narrow. Another example here, here's your distribution area that Mohammed talked about earlier. The market begins to fall back into the distribution zone, and we go up into the zone, no demand. Confirmed by the next bar. Okay, here's your closing. Here's the start of these 2 bars here. That high volume bar. This is your distribution. There's your mushroom top. Down we come, and as we try to go up here, no demand. Bar B confirms it, and we continue down. And then bar C, an upthrust on low volume. And all of these principles will be seen every single day in certain markets. What's the question, sorry? Is that, it's a hidden upthrust. Yep, that's well done. That's very good. It's exactly what it is. It's a massive volume bar. Okay, the bar's closed in the body of the previous bar, and it's the start of distribution. The next bar closes lower. Yes, that is indeed a hidden upthrust. It's weakness. Remember, you're looking for the highest probability trades to make your money. Not, oh, I think that might look okay. You have to have distribution in the background. You have to have a change in behavior, which means the market's making lower highs on each bar, and you're looking for the first attempt to rally on low volume in a downtrend. Because remember that at the moment, this session, we're focusing on weakness. Next session, next Saturday, was focusing on strength. So remember, when you're shorting no demand, okay, this can and does appear in an uptrend, but it's a far more powerful short when there's a downtrend in place. Do not short on no demand in an uptrend. It's in the wrong place. Remember that. If the market's trending up, if you've got blue bars and green diamonds, a bit like what I showed you here, you really, really see here, blue bars, green diamonds, there's no demand. Okay, it's a red signal. It's not confirmed because the next bar closes higher, but you just ignore it. It just say, something that's not in the right place. It's trending up. Now, when this market rolls over and trends down, and you see that, and the diamonds are red and the bars are red, pay attention to it. Oh, yeah. Remember, you're cleverer than a piece of software. Now, the signal here is not wrong. The software is reading what's programmed into it. But we as human beings are cleverer than the software program. So we're going to wait for that market to change over a trend. And once we do, then we're going to be interested in shorting it. Like now, if the market came back down here into this area on this stock MCK, which we were looking at earlier, that Dan identified, if it goes back up there, the diamonds are red, we've trended down, we go up and we see no demand, bang, that's a trade because it's in the right place. Any questions on no demand in a downtrend? Any questions at all? Okay, I'll move on. If there's any questions, just type them in. Now, I wrote in my book about this next principle, and I called it the gotcha bar. And it's an affectionate name for it because what it's doing is it's catching all the longs and beleaguering them. Basically, they don't know what the hell just happened to them because everything has been telling them to go long. And suddenly, bang, without any prior warning, you get this bar. Now, a lot of the time, when you see this bar, it's taken out any previous price support levels and it locks the longs into terrible positions and they often hold on. You should never hold on to a trade if you see this principle. So it's a down bar on a wide spread, closing on the low, that's important, pushing down and through a previous support level. You should have some sort of up move behind you because you will always see this as the price is moving higher. And this price action is used to lock you into a poor long trade. You'll often see no demand after this to confirm the weakness. Now here we can see it. This is the oil chart. In fact, this is my famous YouTube video. And oil we were told it was going all the way up to 150, 200 a barrel. And look what happened. Interestingly enough, the previous weeks we've been going up on no demand as well. So there was a complete clue that something was going on. So is it a breakdown WRB? I don't know what WRB is, Mohammed. You'll have to just type that in. Is it a breakdown WRB? Can you be more specific? Not sure what you mean by WRB. Just type that in and I'll answer it for you. So here we have this widespread down bar, close on the low, but the most important part is the next bar. It closes lower. So we now know a wide range bar. Okay. It's a breakdown. Yes, that's correct. Sorry. Yeah, WRB, because it is wide range bar. Yeah, it is. It's always on a wide range, wider than the previous bars, must close near the bottom 25% of the bar. And the next bar, it's very important, should close lower. But I have seen, I call this a gotcha bar in my book. I have seen the next bar go up on low volume, and that's just as good. That confirms it as well. Okay, so here we see oil, the gotcha bar. Then we look at Tom Williams's simple trending system on the weekly chart if you've been short oil. Down bar, one up bar. Down bar, level bar, ignore it, one up bar. Down bar, one up bar, second up bar, which you can allow for on volume less than the previous 2 weeks. Down bar, one up bar, which you allow for. Down bar, one up bar. Down bar, and we reach the bottom down here. Up bar, down bar, there's the bottom. Up bar on low volume, down bar. And this then moves sideways here until we actually get 3 up bars in a row at $60, and that changed the trend. And that's how it works. That's how that trend works. There was a weekly chart. So oil was at 147, it went to 33. And that happened in the space of 6 months. Oh, I will show that. Okay, John. Yeah, I will show that. I think I've still got it. Yeah, it is funny. Okay, so one of our customers here has just said, can you type in the article? I can. I've still got it. I actually have a copy of this as well. Yeah. There you go. Just to prove the point of what I'm trying to get into your heads about the media and the fundamentals and all of that. Complete nonsense most of the time. There was only one airline, actually. I'll just a bit of trivia for you while we're waiting for this to load. There was one airline in America that hedged the oil market the right way. Does anyone know which airline it is for the star prize today? Which airline hedged oil correctly and went short against all the other airlines that bought at higher prices? Okay, it wasn't American. Anyone have a guess? Well done, Vasily. You win the prize. Well done, Donald. You win the prize. Yeah, well done, Pete. You got it right too. Good. It was indeed Southwest Airlines. I have it on good authority that one of their directors was a VSA customer, but I'm not sure about that. It's just a rumour, but we'll see. Or they saw my YouTube video. But seriously, this is exactly what we saw in May of 2008. An oracle of oil predicts $200 a barrel. Okay, now think about this. We're all influenced by media, aren't we? We're taking this information. We're like programmed with information. So suddenly you see this. Arjun Murthy sees a super spike in oil. It will soon drive oil to $200 a barrel. Okay, soon. That was May. By August, oil had fallen dramatically on that gotcha bar. So this is what I want you to learn today. It's all about learning the principles, but it's also about being contrarian. Trust the chart. The chart doesn't lie. The chart never lies. The oracle of oil was wrong because we now know where oil went. It went down here. There's the bar, look, in July of 2008, only 6 or 7 weeks after we were told that oil was going to go up. And by the way, the analysts always make sure that after they make their analysis, the market does go up for 4 or 5 weeks because everyone says he was spot on. And that gives the professional money the opportunity then to lock everyone in, and they all get it wrong. What's the prize? Silly. I'll think of something. But yeah, I mean, this is how it works. That's right, John. This is you're saying you're staggered. Don't be staggered. This is why I love teaching this stuff, because it's just human nature. It's nothing. That's exactly how the markets work. Okay, it's very clever people taking full advantage of the masses of people that don't have knowledge. You know, masses of people that don't have knowledge. You're one of a small group of people in the whole world that now understand volumes. Very few people. You go into any trading seminar or exhibition, and you start talking about volume, a lot of people will look at you like you're mad. What are you talking about, the volume? They don't even have it on their charts. I find it incredible. Look at this one. Lovely example of a widespread down bar in Forex. And you can see where it took out the price support as the pound was going up. Suddenly, boom. But once you see that bar, okay, you could start looking for no demand bars, look, along this line. But as soon as it starts to move away from the closing price of that bar, any bar like this that goes up on low volume after that is a great setup. Very powerful setup. That's a 1 hour chart of the pound. Yeah. Very good example. Look at the volume on the bar again, the highest for probably 7 or 8 hours, maybe even more than that. But the most important part about this is where the second bar closes. The first bar closes on the low. The second bar closes lower than that. And then the market just staggers sideways. That often happens. When you see that bar, it doesn't continue to fall. The price is held up by the smart money for more distribution before the big move happens. So when you see it, you have to be patient. But the greatest place you can put a stop, right above the top of it. Because well, I've never, ever, in my trading in 14 years, seen the market go back up to the top of that bar and actually take it out. Unless it's a genuine reversal, which would happen after a downtrend is in place. So you're looking for these bars after the market's trended up. Keep that in mind. Tajush just said, I immediately short with a tight stop. Yep. Here's a good example. You know, food firms warn of sugar shortage. And this is what happened. Just as they warned of the sugar shortage, boom, look at that. Gotcha. There's your little up thrust look, and then bang, and sugar just always they do this. They tell us there's a sugar shortage, that everyone's buying sugar, comes out on the media, suddenly a week later, bang, gotcha. All the longs are now thinking, what the hell just happened? I thought there was a shortage, which means prices should go up. It's media hype. It's rubbish. So after you see a widespread down bar, and it's through any previous support levels in an uptrend, it's a major sign of weakness if the next bar is also down. And if you see an up bar, it should look like a no demand bar. Make at least 2 lower highs on the bar to confirm the start of a downtrend. Enter a short trade on a no demand up bar or an up thrust on high or low volume. Really what we're saying here, after you see the gotcha bar, look for the market to start trending down, which means it's making lower highs on each bar, and then look for any no demand or up thrust signal, and that's where you short it. Okay, any questions on the gotcha bar? I call that in my book, by the way, for those of you that read it, it's called the gotcha bar. It's my affectionate name for it. I coined that term because it gets you. It locks you into a poor trade. Tadju says it in the middle of the bar. Not sure what you mean, Tadju. For this signal, it must close on the low of the bar. It mustn't close in the middle. The gotcha bar has to close in the bottom 20% of the bar, 25% of the bar for this gotcha bar. Phil says, is this one of your favourite setups? Yes, I do like it. Yeah, I do like it because you know there's a lot of people locked in the wrong side of the market, and you can quickly get on the right side of the market. And those that are on the wrong side of the market will often just hold on to their positions thinking it's going to recover, and it never does. All right, the buying climax. Aha. Now this is as powerful a signal. It's what we saw in gold in 2011. This is as powerful as a signal as the end of a rising market. Okay. The major difference with this signal is that the spread of the bar is wider than the end of a rising market. So first of all, it's an up bar, which we know, and I'll repeat again, is a bar that's closed higher than the close of the previous bar. It's got a wide spread, and it closes usually in the middle, but it can close near the low, but it usually closes in the middle. It's a very powerful sign of weakness when it's in a strong uptrend with no old tops to the left. So you're just into almost fresh high ground. This signal will probably mark the top of the S&P 500 when we see it. As a market keeps on going, keeps going up day after day, a point will be reached at some time when many traders that have sold prematurely, or those that are not in the market, cannot stand the constant higher prices and frenzy. And it gives the trading syndicates and market makers a golden opportunity to unload large amounts of stock at whole, or any instrument, in fact. This works in Forex, future stocks, at a high price, without their activity resulting in lower prices immediately. Okay, so they get everyone locked in, just like with gold, and then they start selling to them. It can take 6 months, as it did with gold, to distribute everything before the price collapses. This will mark the high point in the market. Oh, okay, Tadjus, I see what you're referring to the previous. Okay, no problem. So here we can see a bar A, a buying climax. Okay, the market is gapped up into fresh high ground. It closes near the middle of the bar. It's on a fairly wide range compared to, well, it's still fairly wide range, but the volume's very high. And then we see the market go sideways, and there's your gotcha bar right here. Look, boom, gotcha. Now, can anyone tell me what bar B is? Let's ask some questions. What's bar B? Based on what I've been teaching you today. This is a quiz. What is bar B? Well done, Mohammed. Brilliant. Very good. Well done, Lars Scorrent. Very good. Well done, Donald. Everyone seems to be learning. This is good. Come on, keep going, everyone. What is bar B? Well done, Pete. Very good. Excellent. It's always rewarding to see this. Well done, Vasily. Very good. Excellent. Excellent to all of you. Good. Okay, what is bar C? What's the name of bar C? We're all getting good at this now. It's an up bar, the volume's less than the previous two bars. What is bar C? Yeah, well done, crikey. Excellent. I'm impressed. I'm impressed. Very, very good. Yeah, it's no demand. That's exactly right, everyone. Bar C is no demand into bar B. And Tadush is saying that, according to my text box, no demand. Yeah, I didn't. Yeah, I was. That is no demand. Exactly. I'm sorry. I just realised I've got a text box there. But you're right, Thomas. It is no demand. That's right. Tadush, it says there's not always a one buying climax that will mark the top. Sometimes you can have two. That is correct. If you're looking at a different time frame, you can have two buying climaxes on an hourly chart next to each other. That can happen. Doesn't happen very often though. That's why I use the bigger time frames to make my decisions. But yeah, I've seen that happen on a 5 and 15-minute chart where you get a signal, say buying climax, and the very next bar goes up and you get another buying climax. That's because they're distributing on the way up. That's why you go out. If you see that on a small time frame, just go to a bigger time frame and wait. And then wait for the change in behaviour. Wait for the market to change. So after you've seen a buying climax, just be cautious. And this is what, this is why I don't short immediately I see it. Because of the momentum of the uptrend, the market may drift up for several bars. There you go, Tadush. So this is confirming what you're saying. Because of the momentum of the uptrend, the market may drift up for several bars or shoot up on an upthrust. A short trade entered at the bottom or low of the first buying climax bar when it's been broken and then goes up into that area on no demand is the best short trade. So basically, what I'm saying there is if you see a buying climax come in, and I'll try and draw it for you. So let's say you've got this massive widespread bar and there's your buying climax, your first one. The market may next bar have another one and go up a bit higher. But the first bar is the most important, so mark the low of it. Then over here, you may well have an upthrust and a market, but you're not short up here. You don't care. You're waiting. Patience. Then we might come down and we might go back up into the body of that bar. We might have no demand. As soon as price action takes out the first climactic bar and goes back up there, and this time as it goes back up, there's low volume, no demand, that's your short. Because this now has rolled over. Make sense? Tadush, does that make sense? So you're not shorting immediately see a buying climax. You're waiting, and then you're waiting for the market to change behaviour. And that's the key to it. Can I ask everybody, yes or no? Does that make sense, what I've just said? Just yes or no. You understand that? Yeah. Good. Good. Okay. Good. Yeah, no, I will be looking. A couple of people have said, could we look at some charts with some examples? Absolutely. Let's just finish this part of weakness. It's important, and then we'll go and look at some actual charts. Is it not dangerous to wait? No. No. It's not dangerous at all. It's patient. You're patient, Mohammed. You're waiting for confirmation. Look, if you want to get in, and someone said to me the other day, Gavin, I saw that buying climax, and it was on I think it was on a currency. He said, you know something, I desperately wanted to short it, but I remember what you said, to be patient. And immediately after the buying climax, the market fell. And I lost 100 pips waiting for the no demand bar. I said, okay. I said, I can show you examples where you go short on that buying climax and then you'd be upthrusted and you'd lost more money. I said, when did you go short on the no demand bar at the bottom of the buying climax? He said, yes. I said, did you make money in the market? He said, yeah, I made good money. I said, no trader I ever met went bust making money in the market. So you didn't lose 100 pips. You waited for confirmation and were patient. You made a good trading decision. Now, it's your choice, sir, I said to him. If you decide next time you see a buying climax, you're going to short it immediately and put a stop above the climactic bar, that's your decision. It's not mine. But my trading plan is based on 14 years of experience. And I've lost money getting in too early because I'm trying to be greedy and aggressive. And I strongly suggest, and I suggested it to him as well, that's why a lot of traders lose a lot of money. Ha, Donald, that's a good saying. I like that. It's always better to be out of the market wishing you were in than in the market wishing you were out. Actually, Donald, I'm going to use that as a great, I like that. That's very good. Never heard that before. You're absolutely right. That's a classic statement. I'll repeat that, actually. It's always better to be out of the market wishing you were in than in the market wishing you were out. That's a classic. Never heard that. That's one for my third book. Thank you, Donald. Very good one. It's very true. I'd much rather be sitting there going, you know something? I missed that opportunity because I know there's another one coming. But I'd hate to be in the market and I'm in a position that's going heavily against me going, why the hell did I do that? It's a horrible feeling. And I don't have that situation almost ever anymore because I'm too disciplined. So when we short, be cautious. Remember that momentum's there. If you remember everything I'm teaching you, you apply to your style of trading and to your discipline. If Mohammed, if you say, you know something, I don't want to wait. I'm aggressive. If I get in, it's my risk. That's true. I'm just teaching you the principles. How you trade them is entirely down to you. I have a trading plan that works for me. It's kept me profitable. It makes me money. And I earn a very nice living trading and doing what I'm doing now. So I'm happy. But everyone's different. That's right, Thomas. There's a difference between actually losing money and not making 100 pips. Exactly right. Everything looks wonderful in hindsight in the market, doesn't it? Always that looks great. Oh, if only I did that. It's much more difficult when you're at the right edge of the chart. You've got to make a decision. You've got to get the timing right. And that's why, for me, the greatest traders I know are the ones that close the losing positions quickly. That's the greatest traders I know. The ones that get out quickly. Because they know, just like I showed this with that natural gas trade on Thursday, that you can take one trade and make it work, and that can make your money for the whole week. Last week, I made more money on the accounts than I had done the previous 4 weeks. And I made any losses I've made were wiped out because it was a good trading week. And here you can see we get, this is the reason why you do not try and go short on the buying climax. You wait, because what happens here, we had a climactic bar just here. The next bar closed lower, but they tested the market just here and decided we were going to mark it up further. And at bar A, this whole area, this whole region, it did go lower. You would have had a little bit of profit there. But this is why I wait, because this is an example, classic example, Mohammed, as where you see climactic action and they test it and mark it up ready for the gotcha bar. So I always wait for that mushrooming over. It definitely has helped me. It's kept me, I'd say, in much better trade. When I'm trading, I'm looking for the highest probability. I'm not saying, I can't sit here for 6 hours. I'd rather not be in the market than in the market on the wrong side of it, personally. And the one mantra I have, there's always another trade, there's always another chart. If it doesn't look right, there's always another chart. And what's made it so much easier for me personally is we've programmed in our indicators into a scanner, which sends me an email when a trade setup appears. I don't have to do the work anymore. I don't have to do any of the work. And all the trade alerts that I get, they're coming to me on an alert system that tells me the VSA principles there. If the end of a rising market appeared tomorrow on a 4-hour chart, sorry, not tomorrow, Monday, on the 4-hour chart of the S&P, I would know about it the second it happens, because I could be in the supermarket, I could be in the pub, I could be anywhere. My phone would ring and it comes to my handheld Apple. I've got the iPhone, and it comes up, alert, trading alert. And I get many of them a day. It's probably over 150. And the ones that I really look for is the end of a rising market and what we call bag holding, which we'll talk about next week. Okay, now the reversals are like the opposite of a spring. This is where it's called a top reversal. It's again, it will often mark a reversal in the trend. Sometimes temporarily, sometimes it can actually mark a top, but mainly it's a reversal in an uptrend. But you could trade it short, there's no doubt about it. This is a common sign of weakness. The first bar gets marked up quite rapidly and closes on the highs. Usually this will be on some sort of good news. The volume can be high or low. Okay, but generally speaking, it's usually high. The next bar rapidly reverses down on a wide spread, wide range, closing on the low. If the low and the close is lower than the first bar, I'll show you this in a minute on the chart, this adds to the weakness. As with all these indications, it's important to read the following bars for confirmation of continued weakness. This sign of weakness is very powerful if you've had a big up move behind you. This is one of my favourites. Now, this was a trade, I actually took this years ago, I never forget this, because it's one of the trades that made me a lot of money, and you always remember those. And I always, by the way, for my trading plan, take screenshots of the trades that made me the most money, because they're the ones I know they're coming back in the future, and I suggest you do that. First of all, at bar A, or the first bar here, where my arrow is, just there, you see very high volume coming in. It's an up bar. It closes just off the high near the middle. Okay. The next bar is almost level with the top, but then it collapses just here. Okay. Here we have a no demand bar. Okay. The volume goes up, the bar closes up into the low of this bar. The volume is less than the previous two. Then we have what we call a test. There's a very low volume down bar. They're testing what's going on here. Now, a test will produce a green arrow. I've taken them off this particular chart. Don't think that's a sign of strength because it failed. If you see a green arrow test and the next bar closes lower, it's deemed to have failed. Mohammed says just about maybe depends on where the volume distribution inside the buying climax bar. It's just a personal opinion. That's fine, Mohammed. I mean, look, the idea of these courses is to give you the tools that you need to adapt it to exactly what you said, your opinion of the market. If we give you the tools to do that and give you some of our strategies that work for us, and hopefully you can adapt some of them to work for you. That's the reason we do this. So we see here that this reverses down and then this test fails. And then the whole market just collapses. Again, you get up bars on high volume, you get failed test. And we'll talk about testing next week, by the way. So I'm not going to explain what a test is now. We're going to cover that all next Saturday. Here's another great example. Look, it's a stock. Market's pushed up on an increase in volume at bar A. Bar B, this is a real good one. They call this an inside bar because it goes up and down and closes below the low of that bar. And then the market staggers sideways. We have another bar here, which has got very high volume on it, which is supply coming in. And then we just stagger sideways. And finally, at bar H, we get our big move coming in, which is an upthrust on low volume at bar H. And that is a very, very weak bar. And as a result, the stock fell quite dramatically. But the most important bar or bars on that example is bars A and bar B. Right, bars A and B, because A is a two-bar reversal looks at two bars. And in this instance, it's looking at bar A and bar B together. And it will produce a signal on both bars. So you'll get two red indicators saying two-bar reversal. So after you see this VSA setup, which will often mark a top, you should wait for the market to trend down, entering a short trade when you see a clear no demand entry or an upthrust on either low or high volume as the market trends down. All right, any questions before we go and look at some live charts on two-bar reversals? Any questions at all? We'll just wait to see if there's any questions at all. Any questions on anything I've covered in the signs of weakness? Okay, I'm just going to wait to see if there's any questions come in. And then I'm going to go through some of the things you should ask yourself before you start thinking of shorting. Yeah, no, Vasily, these are the key ones. Next week we'll do the signs of strength, and then there's 4 or 5 other principles that we add to this, which are based on the similar things which makes up the 20 key principles. So these are the main ones that I want to teach you today, and then next week we'll do the strength, and then there's 4 or 5 other things that I'm going to show you which make up the complete 20. Are these signals valid on, say, 200 tick charts? Yes, they are, Thomas. Absolutely. Yes, they are. Yeah, so next week I'm going to show you how you put together all the signs of strength, and then there's certain principles where we're looking for more than one signal in alignment to actually come in and give us the trade setups. There are 4 main ones that I'm going to be showing you next week. Okay. All right, good. So how are we doing for time? Okay, we're doing okay. So before you take a short position, these are the things you've got to look for. Have you seen a rollover? Meaning, is the market mushrooming over? Or you're in the early stages of an uptrend or a downtrend or still an uptrend? Is the market falling with no professional support? Is the low of each bar lower than the previous bar? I mean, you can allow 1 up bar for every 2 down bars for a downtrend. Remember I showed you that trending system. Are you into fresh high ground when the distribution starts? Remember, end of a rising market happens as the price goes into new areas. Are you in a trading range to the left? Is there lots of good news about the market, about on this particular day you see it gapping up? Question it. Is that a trap? Is the market in an overbought area of the trend channel, meaning you're vulnerable to a fall or a rally, sorry? Is there an end of a rising market or a buying climax in the background, meaning do you have, after this big uptrend, weakness appearing? Okay. And by the way, I should say, is the market overbought? It means at the top of the uptrend channel. It means you've been up and now you're overbought, meaning you're liable to fall. Are you entering on a down bar? Remember, weakness appears on up bars. I've put this in here for you because someone asked me to. If you're trading the commodities, these are the prices and the contracts that you can trade, okay? Because I know 2 of you in here trade gold, and this is the value of each tick of price for each of the commodities. Okay, so every time the price moves with you or against you, coffee, for instance, is $18.75. So all of these here will tell you what those prices are, and that's included in the PowerPoint. Okay, so next week we're going to do all the signs of strength. What I'm going to do now is we're going to go and have a quick look for the next few minutes at some charts. Is there any particular charts that any of you would like me to look at and see if we can find the principles that we've just talked about today? So we looked at MCK for Dan. So any particular instruments that any of you are currently trading or looking at, and we'll go and do a bit of chart analysis. Okay, so Tad just wants to look at the WIG 20, and I can certainly do that. I just need to open my end of day. Well, instead of looking at the WIG 20, we'll actually look at some stocks from Poland. Okay, now I have been following one actually. Let me just, it was Eurocash, I think it was. There it is, yeah. This is an interesting one, okay. So this is a Polish stock, okay, and this is the stock called Eurocash. And a few weeks ago, I'm teaching this particular Polish gentleman. I'm helping him out, and he was going to buy this stock, and we saw these 2 things happening. So I said, "There's no way you'd be buying, no way at all that you'd be buying because of these 2 bars." So here's the principle again. Look, and what have we got on this bar? Up thrust. So you've got 2 signs of weakness, but most importantly, there on the Eurocash stock, the diamonds were red. We're trending down. And you can see it's been marked up artificially. So that's still going to go down. That's still got a way to go on the Eurocash stock. And the other stock that I was looking at, I think it was Boris. Let me have a look. I think it's that one. Yeah, this is this one. This one was interesting because when I was out last year and I was doing a mentorship course, we picked out these principles here. In fact, I've still got the recording. We had the stopping volume, and then it was followed immediately here by this test that was successful. So over the coming weeks, we forecast this would be a stock that would act stronger than the index. And in fact, this particular one did act stronger. But here's a classic example of the upthrust, look, at weakness. Because at some point, It's not the highest volume upthrust, but it's a genuine upthrust. No, meaning that at that point they're trying to lock people in to bad trades. So on this particular instrument, you can see what an upthrust. If you're long and you see something like that, and the volume's pretty high still, and the next bar, remember you're looking for the next bar to close lower, which it did. That would indicate to you that you're going to see falling prices. And the WIG 20 is actually looking a bit bearish at the moment when I looked at it last time. Pete wants to look at SFM. I'm assuming that's a US stock as well. So let's go back and see if I've got that in my scanner. Okay, let's go to the daily chart. That's interesting. It's actually got a springboard here that's happening. I wouldn't do anything with this yet, personally, but what I can see here, you've got very high volume in this up bar. They've tested it. They've come back down. That's a spring. Now, this is what Wyckoff would refer to as a spring. And if this clears the top of that bar, then I think you could go long. Even though you've got this downtrend, it's trying to spring. So this is accumulation down here, and that is a classic example, look, of a springboard down here. And it's even got a signal on here, a test in a rising market. That's actually one of my favorites. If that was higher up, I'd probably immediately buy it. I would wait, though. This is a daily chart. I'd give that a few more weeks just to see if it rallies. But certainly, if it gets up into these areas here, it's going to go higher. Definitely one for the watch list for sure. Okay, let's go and have a look at silver. Okay, SLV. Yeah, I've been following silver intently because it's been some very interesting move, and gold has been doing some good stuff as well. But I think next week we're going to see a decent move in these instruments. So we'll look at the SLV on the weekly. This is the ETF of silver for those of you that don't know. All right, so you can see where my trend lines are drawn. You can see the gotcha bar. That's clear. You can see that bar there, if you projected it out, found its resistance here, they upthrusted. This is what you always do. When you see the gotcha bar, is a good idea is to put a line and project it out and leave it. And you watch what happens as price goes back up there, you see. Rejected it, came up, upthrusted it. Look at that, hidden upthrust. Perfect. Everything I just taught you, right there. Came back down, goes back up. Here, no demand. Everything you just learnt today is on that chart. Comes to the top of the channel, comes back down. Here's your support line. Now, where do I think silver's going? I think it's going to 15. Okay, I'm still short. And the reason I'm still short is you've got weakness here. We're trending down. This is the key level. Now, for those, someone said to me, if I'm not short already, where would you want to be short? Put an order in below there. Okay, because this could easily upthrust again. So I've moved my stop down because I do expect a markup. Okay, but before they actually take this lower, they'll bounce it to the top of the channel. So I've got a very tight stop in here. In fact, I can show you. Okay, so my stop here is right there. Okay, I was short from 27. I was short up here. Now, this is a longer term position trade because I'm trading it on the ETF. But yeah, I think silver's weak. I don't think people are saying that smart money are coming back in and buying. Load of rubbish. Complete load of rubbish. Okay, let's look at that looks like Thomas, can you confirm CLIR? Is that right? I can see CLIR is what I'm seeing there, which is a US stock. Is that right, Thomas? Yeah, okay. Ah, I see where you've picked that one. Yes. Oh, that's a very nice stop. Yeah, I can see why you picked that one. That's an upthrust. Thank you, Thomas. You've just found me a potential setup there. Yeah, that is definitely an upthrust. Number 9. It's immediately followed here by no demand. It's come back down. They're testing this area here. Yeah, there's a lot of resistance at that level. Hasn't changed behaviour on the daily yet, though, so I probably wouldn't be shorting it just yet, but certainly that's some weakness up there. But because of this trend here, it's interesting. I always like to wait for the change in behaviour. This has not changed behaviour. It's trending up still. Okay, so that could still upthrust a second time. So again, wouldn't be short there. Weekly chart, yeah, there's a lot of supply here. There's a lot of weakness on this chart on the weekly. And it's made another high here. That's definitely one I'd be watching. Let's put up a few more bars and see where we're at. I think that's the most I've got. Yeah, I would strongly suggest you watch it. It's still trending up on the weekly. It's trending up on the daily. Again, a good bet here would be to mark the close of this bar here, where the wide spread is. The volume isn't really that high on that bar, which concerns me, because if that's absorption volume, then you'll see a test on the weekly chart, and that could go higher because the parent index is going up. So I would be, yeah. Can we have an upthrust under low volume? Yes, you can. You can have low volume upthrust, Mohammed. Yes, absolutely. Yeah, so definitely one for the watch list. Thank you for that. I'll keep it on there. And finally, to wrap up then, let's look at the euro, which is the 6E contract. I trade the currency futures mainly, so we'll look at that. I was trading this last week, Phil. Yeah, I did trade it. What's my opinion of this? Well, I'm just about to show you. I think we're in for a decent move next week because we had the news. Now, first of all, the euro was trending down, as we know. We had this bar come in here, all right? Now, there was some support came in at that level, as we know. Then we've had a massive up bar here, and it looks like we're trying to test it. For me, the minute we go through this red line, which is my trigger number, as soon as we go through there, and you can see I've drawn it, and there's a reason I've drawn that, as soon as it goes through there and I get a no demand bar on the 4-hour chart, I'll be short again. So I think it's weak. But if you look at the actual where it's done, this is a classic example here of distribution. Okay, so they've distributed up here. Very clear reversal look. Okay, we call this a buying climax. It's not, I prefer to have seen that on that type of volume. That's what I'd like to have seen. Now, if you look at the setup, if you look at the volume here, and you look at what happened here, the test, if you see a test here at the same level that is, it'll probably bounce and go back up. So I'm not clear yet which way I want to trade this. I'll probably know more next week. And if you're in the live trading room, some of you are, then we'll be trading this on Wednesday. So we'll know a lot more next week. Great. Okay, I'm going to wrap up then. It's 6:05. I sort of overrun a little bit, but I hope you've enjoyed it. I hope you've learned a lot. I've covered pretty much everything that I wanted to cover today. I've got a lot more to cover next week. I'm looking to be with Tom next week as well, and we will definitely overrun next week because we've got some extra slides to show you. I will get the recording uploaded to the website. That will be with you on Monday, together with the slides. Okay, so I just want to say to all of you, thank you very much indeed today for your attention and your time. I'm glad you've. I said I didn't get lots of questions, so I'm assuming that you've grasped what I've been showing you. That's important. Thanks, Dan. Good. You learned a lot. Good, good. That's the most important thing. So I'll get this recording up for Monday for you, and I'll see you. For those of you who are in the trading plan seminar next week, we start on Monday, and I shall look forward to seeing you all then as well. So from me, have a great weekend. God bless everyone, and I hope you have a really profitable week next week, and I'll see you next Saturday if you're on this course. Take care, everyone. Have a great rest of your Saturday and a great weekend. Bye-bye.